Okay. Hello, everyone, and welcome to the Advanced Audit and Assurance Class 1. So today we'll be looking at the meaning of assurance, audit, and non-audit engagement. Now, I need all of you to note that this class is like a build-up of on the principle of auditing, and we already have a certain expectation that you understand the basics of understanding, although some part of it is going to be revised here. So in this class, I want you to prepare your mind to learn audit standards. You see a lot of that even before this chapter, before the chapters. So you have to learn audit standards because they are going to guide you on what happens in practice, the best practice that you need to adopt. That said, welcome everyone to the class once again, and let's get right into it. So we'll be discussing the meaning of audit and assurance, chapter 1 of the study pack, the ICAN study pack. And this is the latest study pack actually, so I think I want to believe that you have the latest study pack because it's been revised. So now the meaning of audit, chapter 1. So we're looking at the meaning of assurance, the meaning of audit and audit related services. Now before we dig into that, we need to understand the objective of this advanced audit and assurance class. So the objective of this class is to extend your basic awareness of professional codes and fundamental principles. We'll be looking more into that as we progress in the chapters. So you can have a detailed understanding of the rules of professional conduct, because as a professional, you have to behave in a certain way. You have to be ethical. You have to uphold some ethical standards. We're looking at that. And this advanced audit and assurance also to introduce you to practice management. What exactly happens in practice from the engagement stage to the planning stage to what happens on the field to coming back for review and then the reporting process. So we're going to look at that, what happens in practice. Then it's also to extend the application of procedures involved in planning, conducting, reporting on audit assignments and non-audit assignments, and deal with group audits and audit related services. So basically you'll be learning about audit procedures at the different stages of audit. It's also to provide a critical evaluation of procedures and reports. So basically audit procedures and how reporting is done, and also to give you an understanding of where was I? Okay, I was talking about the objective of this advanced audit and assurance class. So these are the 5 basic objectives of the advanced audit and assurance class. Now, what exactly is assurance? What is an assurance engagement? This is what we're looking at first. So an assurance engagement, you have to take note of the keywords here. An assurance engagement is, in an assurance engagement, a practitioner, is the keyword, is engaged by one party to give an opinion on a piece of information that has been prepared by another party. You may have to go through that again to have a good understanding. It says again, in an assurance engagement, a practitioner, a professional is engaged by one party. There's an engagement by one party to give an opinion. It is an opinion, not a conclusion. It is an opinion on a piece of information that has been prepared by another party. To give an opinion on an information that is not prepared by the practitioner, it is prepared by another party. Now, from your introduction to audit, you're going to understand that the opinion that we're giving is just an assurance, reasonable assurance, not an absolute assurance, is a reasonable assurance or a comfort about the information that's been reviewed. And this is because of the separation of ownership from management. That's the agency theory, where the owners of the business want to be sure that their resources have been properly managed by the management, who are the board of directors, who are also responsible for preparing the financial this information that we are reviewing in the audit. So the opinion is an expression of assurance. It just adds credibility to the information that it is not materially misstated, and they can go ahead to make a decision based on what is inside the financial statement. Now, a statutory audit. Now, we looked at the type of audits in under the basics of auditing. where we have the statutory and also the voluntary. But in this case, we're talking about statutory audit. That's the one that is mandatory, that's the one that is obligated on companies to carry out. Now, the statutory audit is a form of assurance engagement. It is a form of assurance engagement. So everything we do under audit is under assurance, is known as an assurance engagement. So audit is just one form of assurance engagement. Now, the shareholders of a company do not accept without question that information. So I've explained this already, that the purpose of an audit is basically to add credibility to the financial information that is prepared by the board of directors to the shareholders who are the owners of the business, just for them to be sure that they've not been cheated, and their property, their resources have not been mismanaged by this board of directors. Now, statutory audit provides a high level of assurance, also known as a reasonable level of assurance. Reasonable level of assurance that the financial statements are free from material misstatements. So keyword again to note is just a reasonable level of assurance. It is not an absolute assurance, because if you remember in your introduction to audit class, there are a lot of judgments involved in the audit, from the planning stage, determining which area actually has a high risk, determining the areas to look out for, also the audit procedures to perform based on your understanding of the client. There's a whole lot of subjectivity that goes into the audit. That's why we cannot give an absolute assurance about the financial information. We can only give a reasonable level of assurance. Now, there are other assurance engagement that may provide a limited level of assurance. Look at that later, and even some that don't even provide any level of assurance. And we'll look at that as we go on. Now, examples of non-audit assurance engagement. Now, remember, we said audit is just one form of assurance engagement. We have others. So these are the other assurance engagements that a practitioner could be engaged into, like provide an opinion on some information. So we have areas like corporate social responsibility, environmental policy, employment policies, non-financial performance indicators. Now, you need to know that all these information are not mandatory. They are just like voluntary information that the board of directors decide voluntarily to provide in their annual report. And if you remember from the introduction to audit class, we talked about the scope of an audit, that the scope of the audit is just the financial statement. Those are the 5 elements of the financial statement, 5 statements, which are the statement of financial position, statement of profit or loss, statement of cash flow, change in equity, and also the note to the account. Those are the components of the financial statement, which is actually the scope of the audit. Now, together with this our financial statement, companies can decide to provide some voluntary information like this: corporate social responsibility, environmental policy, employment policies, non-financial performance indicators. And under the audit, we are not responsible for all this. So if the management now want to add some credibility to all this voluntary information, they can engage a practitioner to provide a non-audit assurance about this particular information. So they are the one that will go about reviewing and giving an opinion as to whether or not it is free from error, or it is properly stated, or whatever. Now, over the years, assurance engagement have become very significant due to increase in the range of information provided by directors in report. As we said, in the annual report, not only your financial statements are included, there are a lot of voluntary information that are also included. That is why there's an increase in assurance engagement, not necessarily audit engagement, but assurance, non-audit assurance engagement, right? So an auditor can provide assurance, which is reasonable assurance, by giving an opinion about the information in this report, that if it is contained in the scope, that's in the audit engagement, but this is primarily not the scope of an audit engagement. Okay, now element of an assurance engagement. So an assurance engagement performed by a practitioner will consist of the following 5 elements. You need to note this: a 3-party relationship, which includes number 1, the practitioner, aka the professional, Number two, the responsible party, that's the individual that provides that provides the information, that prepares the information, yes, that's the word, that prepares the information, and also the intended users, those who intend to make a decision on that particular information that is prepared. So that's a three-party relationship: the practitioner, the responsible party, and the intended users. And then we also have the subject matter, which is subject matter is basically what is the focus of the assurance? What exactly are we providing an assurance on? And that subject matter is that particular information. Like we said, it could be a corporate social responsibility um, report, it could be an environmental policy report, employment policies, whatever. There has to be a subject matter for that particular audit engagement that they need to give an opinion on. And there also has to be a suitable criteria. Now, before you can say you are done your examination and you want to give an opinion, there has to be a basis of that particular information or of that particular opinion. What was the standard used to evaluate that particular information? Because you can't just give an opinion because your opinion, you feel like this information is wrong. What is the basis of that opinion? That now becomes the suitable criteria. And in our case, the suitable criteria is our international financial reporting standard that we use to evaluate whether the financial statement is properly presented, and also that the figures are actually right, the presentation is right, and everything is done according to standard. So we have the international financial reporting standard, and then we also have our international standard on auditing, which is what we are going to use to evaluate that particular information. But in the case of non-audit assurance engagement, there could be other standard depending on the nature and also the subject matter that is being considered, that that the auditor is going to, that the assurance practitioner, not the auditor, because like you said, audit is just one type of assurance agreement, that the practitioner is going to base his opinion on. There has to be a basis for that particular opinion. And then we have sufficient and appropriate evidence. Now, before you can say you want to give an opinion on something, apart from having a standard, you have to be convinced that you have gotten enough evidence to reach that particular conclusion. Have you gotten enough information? Have you gotten enough source documents? Have you gotten enough representation, written representation from the right party? There has to be sufficient and appropriate. Sufficient is in terms of quantity. Now, appropriateness is in terms of the value. So you can't just be gathering, you can't just be saying you are gathering enough information. The real question is it enough? Number one, that's the question of sufficiency. And then the question of appropriateness is it relevant to what you are examining? So we're looking at, is it enough? And also the information that you're saying is enough, is it relevant? It's not like you want to evaluate financial statement now and you are trying to get something that is totally unrelated to the financial statement. You are making inquiry maybe about how staff sign in, although that can also be relevant information. But depending on the nature of the engagement, you have to be sure that the information that you are gathering as an evidence are actually relevant to what you are carrying out at that particular moment. And then also there has to be an assurance report. So assurance report is now where you express your opinion, and if there's any issue that's being raised, that will be represented in the assurance report, basically giving a report of all the work you've done on that particular information. So you have to know this element of assurance engagement. Every assurance engagement, be it audit or non-audit, goes through, contains this particular assurance element. Now let's look at the meaning of audits and audit-related services. Now, like I said earlier, you have to know your standards. You have to know all the standards. I think it starts from ISA 200 to, I think it should be up to 800 now. Or I know 700 is about audit, but you just have to know all these standards because they guide what you do in practice when you get to an actual audit engagement. Now, ISA 200, just so you know, is the objective, is the overall objective in the conduct of an audit and assurance in accordance to the international standards on audit. So when you see ISA 200, it's basically about the overall audit um, objectives. Now, the ISA 200 states that the purpose of an audit is to form, purpose of an audit. Now, they're highlighting it again that an audit is just one form of assurance engagement. Let that stick into your head that it's just a form of assurance engagement. Now, the purpose of an audit is to enhance the degree of confidence of intended users in the financial statement, basically to add credibility, to provide some comfort, to provide assurance that the information provided to the intended users are actually free from material misstatements. Now, and how is this achieved? It's achieved by the auditor expressing an opinion, keyword, or expressing an opinion underlined on whether the financial statement, that's the scope of an entity, are prepared in all material respects. We'll be looking more into all of these elements as we dive deeper into the audit, because all of them mean, they all have their meaning. Like, they are not just words loosely thrown. They all have their meaning and their significance when we're talking about audit. In accordance with an applicable financial reporting framework, which we know is IFRS in our case. So if it was in US now, we're looking at USGAAP. So we have to know the applicable keyword, applicable financial reporting framework. So it goes further to say that the financial framework could be country specific, could be by country specific legislation plus international financial reporting standards. So depending on the country specific legislation, there are a lot of countries that don't apply. Okay, not a lot. A lot are actually under the IFRS, but then countries like US, they don't want to agree that the IFRS is what they can adopt. They believe theirs is superior, and it actually is more complex than what we have in the IFRS. So the audit opinion typically makes reference to whether the financial statement gives a true and fair view. I'm sure if you pick an audit report, you'd have seen something like this, words like true and fair view, or it presents fairly the financial position and results of the reporting entity. So statutory audit takes a lot of process, a lot of established formalized processes, which are actually stated or identified or are specified by the auditing standard. 1 minute, please. I want to plug my laptop. Okay, sorry about that. So audits are long established formalized processes closely regulated by law and professional practice. So audit is not just something that someone will just wake up and say, I want to become an auditor. Audit is closely regulated by law and also professional practice. So you can't call yourself an auditor if you are not a chartered accountant. For example, you have to be a qualified, competent individual before you can say you are an auditor. An audit came about as a result of the separation of ownership from management. I talked about that at the beginning of our discourse. Okay, so what are some audit-related services? Audit-related services. Keyword: audit-related. Related. They are related to audit. They look like audit, but they are not the statutory audits that we are focusing on in this particular course. They're just audit related. So audit related services are engagement undertaken by an accountant or a firm of accountants to perform assignments such as review of data, agreed upon compilations, and also agreed upon procedures and compilations, agreed upon procedures and compilations. So now we have to evaluate what each of these means. But before we do that, I'd like to take questions on what we discussed about assurance engagement and also audit. So if there's any question, please let me know. 2 minutes for that, please. Questions. Is there any questions so far?
Kolapo Rohim, if you have any question, you can unmute your mic and ask your question.
Is it the only one in class?
Yes, it's the only one there at the moment.
Wow.
I think somebody is trying to connect also. So you can continue. I don't think he has any question.
Is he following the class too? Can he like give a thumb up if it's in line with what we're doing here?
Hello, ma.
Yeah. Hi.
Yeah, I'm
Kolapo.
sorry. Good morning, and thanks for the class. I'm following, and I'm enjoying the class. So I don't know if at the end of the class I can ask 1 or 2 questions I have, but I don't want to interrupt now. And like I've said, I'm following and I'm enjoying the class.
Okay. That's fantastic. Thank you for your response.
Thank you very much.
Okay. Now let's dig into the audit related services. So these are engagements that are similar to an audit, but they are not exactly an audit, and they are also conducted by a firm of accountants. Now you know that in firms of accountants or accountants that provide um, services, we call them accounting firms. Yeah, accounting firms. So now what's a review? So a review provides a low or moderate level of assurance that the information under review is free from any material misstatement. It doesn't provide a reasonable assurance. It doesn't provide a high assurance like the audit, because obviously the process is um, not as well established, or as it's not as serious. That you serious. The process is not as extensive. Yes, that's the key word. It's not extensive as the statutory audit. So it gives a low level of assurance, and the assurance comes in the form of a negative assurance. And this is the way it comes. It said, nothing has come to our attention to suggest that the information is materially misstated. Nothing has come to our attention. So basically, they are looking for something that will come to their attention. Nothing has come to our attention to suggest that the information is materially misstated. And this is not how audit goes. So audit goes, whether audit in an audit report, the opinion is basically either that the information shows a true and fair view, or it is fairly presented in accordance with assurance, international standard of auditing, IFRS, and all those standards. But in this case, the assurance is a negative assurance. It's a negative assurance. It's a negative assurance. So now the higher level of assurance provided by an audit enhances the credibility provided by the assurance process. So the credibility that a statutory audit gives, a review cannot provide that, because it's not extensive. The procedures and the standards are not extensive as that conducted in an audit. So audit is more time consuming and also more costly than a review. So and anybody could, and a practitioner could just be engaged to review a particular information or document that belongs to a company, just for them to identify maybe errors depending on the objective. And then we also have agreed upon procedure. So in this case, as it sounds, agreed upon procedure. So the person engaging the practitioner tells the practitioner that this is what I want you to do, and this is how I want you to go about it. So the procedures are actually agreed upon. So agreed upon procedures are adopted in an engagement where the party, that's the client, hiring the accountant, specifies the procedure. They tell you, I want you to check A, B, C, or I want you to prepare a payroll for me, and this is the way I want it to be prepared. So use this particular procedure to do your work. Specify the procedures that should be followed by the accountant in performing the engagement. So the procedures are agreed upon. It's not something that the practitioner can say, this is my way of going about it, or this is the standard I want to uphold. No, it's the client that tells you exactly the procedure that he or she wants you to actually perform on the information they're providing to you. And then we also have compilation. So with a compilation, the accountant is engaged to prepare information for the client. For example, preparing a financial statement, performing accountancy work for the client, preparing, doing tax computations, all those are part of compilation. So it says rather than audit or check the information prepared by somebody else, in this case, you are the one asked to prepare. You are the one asked to prepare that particular information. So the practitioner is engaged to prepare or to compile or to compute something instead of checking something. So there's no assurance provided in a compilation. In an agreed upon procedures as well, there's no assurance provided in an agreed upon procedure. So the only thing that can happen in an agreed upon procedure is the presentation of your report that shows the facts that you have founded, the facts that you have identified from that particular information that was given to you by the client. So the only audit-related services or audit-related engagement that provides some level of assurance is just the review, and that provides a very low, not very low, a moderate or a moderately low level of assurance. So that's it. We come to the end of this chapter. We'll look at the next chapter shortly. So before we go to the next chapter, you have to check that you now know how to explain the basic concept of assurance. So you know the concept of assurance, as we explained earlier, that an assurance involves a practitioner who is engaged to give an opinion on a piece of information that is provided by that is supposed to be evaluated or used by an intended user, or assurance. And also you have to know that you know the definition and the objective of an audit, and also the level of assurance that we have, and also be able to describe and explain the audit-related services that we just looked at now, not quite long, which includes the review, the agreed upon procedures, and also the compilations. So you always have to check that before you go to any chapter, that you have a good understanding of what you just read. So I think I would like this part to be very interactive. So Kola Wole, right? You may have to unmute and let's do this quickly. Yeah.
Thank you very much.
Okay.
Yeah, my name is Kola Pora. Not Kola Wole.
Oh, Kolapo, sorry about that. Kolapo.
Yeah, thank you very much. So I think I've been able to establish the difference between audits and assurance and review. But my question is for the three.
Okay.
Does it require a qualified accountant, chartered accountant, to be able to do the three, or like based on experience? Because I learned that assurance should be done by, unlike the audit, that will be carried out by a qualified accountant. Assurance can be done by professional. So when we're talking about professional, is it professional by experience or qualified accountant?
Okay. That's the question. What else?
I think that is it for now. others, I think I'm pretty clear on the topic.
Okay. So before I answer your question, first of all, audit is a type of assurance. So there's no like they can't exactly be separated. Like you mentioned, audit, assurance, and audit review. So audit is a form of assurance. So when we're talking about assurance, audit is also included in that particular bracket.
Okay.
Yeah. So for audit, of course, you have to be a qualified accountant that's qualified under our ICAN, ACCA, professional bodies, basically. While for a practitioner, you may not necessarily have to have an ICAN, depending on the subject matter again. Now, it depends on the subject matter. Now, for example, let's say you want to evaluate an employment policy, for instance. You want to provide assurance on an employment policy. Of course, you have to have your CIPM. You have to be qualified in that might to perform that particular kind of service. You can't just come and say I want to. No, you have to be qualified in that particular profession or in that particular area. So either you have your CIPM and you have some experience. Yes. So because when you're a practitioner, we expect that you are a professional and you are experienced. You're a professional, you have some experience. It doesn't have to be 20 years experience. It all depends on the nature of the engagement and what even the client even wants. So if they say that they want someone who has the extensive years of experience, or they want to go for an HR firm now, for instance, for an HR firm, well, that's their choice. But then the key thing is that the people that we call practitioners are those who are qualified to perform in that particular might and also have some experience. So have I been able to answer your question?
Yes, very well. Thank you.
Okay. And I think you asked a question about qualified opinions, right?
Yes.
We'll talk more about that inside the reporting, under reporting. So we don't get to like jump
Okay.
stages, yeah, because before you get it, there's a whole lot of procedures, a whole lot of evaluation and examination, evidence collecting, sampling, a lot of things that goes into the audit before the report is now finally like produced. So that's just like the end result of an audit. So let's not jump.
That's
Okay. So let's have this quick quiz together. So I guess to evaluate whether you have a good understanding of what we just did, what we just discussed in the last 30 minutes.
okay.
So which of the following is not an assurance engagement? Number 1, A, an audit of financial statements. 2, a review of financial statements. 3, an agreed upon procedures engagement. 4, D rather, is on a company's compliance with its environmental policies. So which is the answer?
It's D.
D?
Yes.
Are you sure? Is that your final answer?
Yes, yes, it is.
Is that your final answer?
Yes, that is it. D.
Okay, I'll explain from the beginning. So audit, like we said, is a form of assurance engagement. It provides reasonable assurance. Review provides a low or moderate assurance. Agreed upon procedure provides no assurance. We discussed that now. An agreed upon procedure engagement provides no assurance. The end result of an agreed upon procedure engagement is just a report of the fact that you are founded. And then, so that means the answer is C. But then for D, a report on company's compliance with the environmental policy, we looked at that at the beginning, at the beginning of our explanation as to what an assurance engagement, some other kinds of assurance engagement, when we talked about evaluating corporate social responsibility, employment policies, environmental, yeah. So they are just non-audit assurance engagements. So,
Okay, environmental policies.
what do you say?
I say I can see the environmental policies.
Exactly, environmental policy, employment policies, non-financial information, performance indicators, and corporate social responsibility. So these are non-audit assurance engagement, but they are assurance engagements, so that they are not audit assurance engagements. So are we clear on that now?
Yes.
Okay. Number 2, an audit may never offer absolute assurance. Which one of the following statements does not support this statement? Read again. An audit may never offer absolute assurance. Which one of the following statements does not support this statement? Number 1, audit evidence is persuasive, not conclusive. B, audit opinion is a matter of judgment. C, in a simple audit, it should be possible for the auditor to test all the transaction undertaken. D, there is an inherent limitation in any accounting system and internal control system. So what's your answer? Which of the following statements does not support that audit cannot provide an absolute assurance? So what's your answer? Tick tock, tick tock, tick tock. What's your answer?
I think I'll go with
5, 4, 3.
I'll go with B.
B. Okay, let's evaluate again the question. An audit may never offer absolute assurance, which is true, like I explained, because look at that we under now. Which one of the following statement does not support this statement? Like I said earlier at the beginning of this class, I said an audit cannot provide an absolute assurance because there's a whole lot of subjective activities in terms of determining the risk area, in terms of determining the appropriate audit procedure that is necessary for that client or the circumstance of that client. So audit is it's subjective. Yes, that's one of the reasons I explained. Now, A, audit evidence is persuasive, not conclusive. We look at this in introduction to auditing class. Audit evidence is persuasive, it is not conclusive. Why? Because this is actually not part of the answer, in the sense that this supports the fact that audits offer only reasonable assurance, not absolute assurance. Now, 1, audit evidence is persuasive and not conclusive. The fact that you have gotten a particular evidence to support your opinion does not mean that there are no other procedures that you could have conducted if you saw the situation of the client in another light. For example, when you're in the audit, when you're on the job, and then you conduct a particular test, and whatever you've done now goes for review. Now your manager can say, you should have done another type of test, or you should have done this particular type of test better. And also, let's say the account was even signed in this year. There's the likelihood that when the account is reviewed again by the auditor, by maybe an engagement partner or the management partner, they may see errors that they couldn't identify in the previous audit. So that supports the fact that audit cannot provide absolute assurance, only provides reasonable assurance. So the answer is not A. B, audit opinion is a matter of judgment. Yes, as I said, a lot of subjective activities goes on in an audit, so it is a matter of judgment. That's why we cannot have absolute assurance, right? C, in a simple audit, it should be possible for the auditor to test all the transactions, and this is wrong, because an auditor cannot test every transaction.
Yeah. Because is that one simple that's confusing?
What do you say?
I thought it's the word simple that is there that made me think it is not the answer.
No, you know what? We're looking at statutory audit, whether it's simple or not simple. I think that was just a word game we were playing. But in every statutory audit, it is not possible at all for you to test all the transactions because you are coming after the end of the financial year and you are giving maybe a month or even sometimes you are giving only 3 weeks to evaluate transactions that went on for 12 months. So how is it possible for you to test all the transactions? It is absolutely not possible. And because you cannot test all the transactions, you can also not provide an absolute assurance. See? So the answer is C. Now let's look at D anyway. There are inherent limitations in any accounting system and internal control system. This is so true because in every system, I mean, a system was made by a human being. The same human being can break the system. Like if an authorization or an approval process or a system was established now by maybe the board of directors, sometimes they override even what they've done. They override such controls. So there's that inherent limitation that you can do absolutely nothing about. That you can do nothing about. Yeah. So the answer is C. So that is today. So if you are rephrasing it, it means that an audit cannot provide an absolute assurance because um
It is not possible for
one
you to test all the
exactly
transactions.
it is exactly because also it's not possible for you to test all the transaction undertaken. So is that clear?
You are very correct.
Okay, 3. What provides the highest level of assurance? Highest level of assurance. A. Limited assurance engagement. B. Audit review. Audit, sorry. C. Review. D. Compilation.
Is what it.
Audit, yes, because audit gives the highest level of assurance, it gives a reasonable assurance after conducting a lot of in-depth, extensive procedures. Review gives a low level of assurance. We saw that already. Gives a low level of assurance or low or moderate level of assurance, that is in a negative form, that to say that the information you're providing us, we've not been able to identify any fraud and stuff. But in the case of compilation, we know that there's no assurance provided in a compilation because you are preparing rather than reviewing, rather than examining. So there's no assurance provided in a compilation. There's a low or moderate level of assurance provided in a review. The highest is provided in an audit. Limited assurance engagement. Who knows what that is? You don't know what that is. Number 4, a statutory audit is what form of engagement? A. Agreed upon procedures. B. Compilation. C. Limited assurance. D. Reasonable assurance.
Is
What's your answer?
reasonable assurance.
Yes. It provides reasonable assurance. That's correct. So number 5, which of the following combinations describe a review? A. Reasonable assurance provided, positive opinion expressed. B. Limited assurance provided, negative opinion expressed. C. An audit of financial statement, ISA 250. You can see we've already started playing with standards. The first one we considered was ISA 200, which I said was the overall objective of an audit in accordance with international standard of audit. So you have to know all the standards. Like when you ask a question or when you see a case study, for instance, you should know the appropriate standard. Oh, according to ISA 250, it should not be done this way, or this is the way it should be done. This is our expectation on our examination. So you have to know all of these. You have to know all of these standards. Know all of these standards. Yeah. Okay. So and yes, I advise you that while you are going through your study pack, try to read all these things. Read them. In fact, before the beginning of the chapters proper, all those notes that they wrote, all those tables and stuff, and even the standard, I think it's before the chapter. Try to go through them. Try to go through them. Try to go through them. So this is the expectation of this chapter. So by the end of this chapter, students will be able to explain the need for regulation of an audit and assurance, why it is necessary for audit and assurance services to be regulated, explain the process of appointment, resignation, and removal of auditors, describe the eligibility, rights, and duties of an auditor, and also describe the role and structure of professional standards, including the standard setting process, summarize the key features of corporate governance related in relation to audit, explain what money laundering is. I'm sure you'd have seen things like money laundering act in banks. They usually put on their walls that they have to be in compliance with money laundering act. Okay, explain what money laundering is and summarize the obligations and duties this places on the auditor. Apply ISA 250 to the audit of financial statements. ISA 250 is still the same, understanding laws and regulations, consideration of laws and regulation, and audit of financial statements. So note, you need to know your standards, you need to know your standards. So for the first part, so we want to consider what exactly is the need of what's the need for regulation in the audit and assurance services. So we're looking at public interest, ethical regulation, legal regulation, and appointment of auditors in Nigeria, according to KAMA, 1990, removal of auditors, resignation of auditors, eligibility to act as an external auditor, rights and duties of an auditor, blah blah blah. Okay, public interest. Now, it says that the key reason why audit and assurance services should be regulated is to serve the public interest. Now, remember, an audit is to provide credibility or about on the financial statement, which is to be used by the intended user. If you remember what we talked about under the element of an assurance, yeah, that we have the three-party relationship where we have the practitioner, the party preparing the information, and then we also have the intended users. So as an auditor, we are examining information basically to safeguard or to provide some comfort for the intended users, depending on what they want to use it for. So an assurance provider gives an impartial, that's a very independent professional view on issues that matters to the users of financial and other information, right? And you also know, you have known by now, I think under your the corporate governance and ethics, that we have different users of financial statement, not only the shareholders, although the audit report is primarily for the shareholders. There are other stakeholders. There are other stakeholders who use that or who make decision on the audited financial statements. So as an assurance person, you are expected to provide an impartial, very professional view on issues that matter to the users of financial statements. It's important that this view can be trusted because we want you to add credibility to that particular information, right? Now, therefore, an assurance provider needs to operate within ethical boundaries and consistent standards. Now, remember, when we're talking about the element of an assurance engagement, we talked about suitable criteria, right? I'm sure you remember that. We talked about suitable criteria as part of the element of an assurance engagement. Now, this is where it comes in. This is where it comes in. The suitable criteria is that the auditor or the assurance provider is working within ethical boundaries and consistent standards. Now, the auditors or the assurance providers are regulated by the law of the land in which they operate. So we have the KAMA, in which they operate. the ethical standard of the land, and the professional body like the ICAN. And then we also have professional standards adopted by their country. For example, the international standards on auditing, which is what we're applying in Nigeria. So ethical regulation. So this is where they get the ethical guidance. So they get ethical guidance from ICAN. ICAN has their own ethical guidance or guidelines. Yes, they also get ethical regulation from law and also from IFAC. So IFAC is International Federation of Accountants that supervises all these audits and IFAC. 1 minute, please. Okay, now legal regulation. So most countries have legal requirements associated with some assurance providers, particularly auditors. Examples include we have the ICAN Act of 1965, we have the CAMA, which everybody knows. We have the Bank and Other Financial Institution Act. That's if you are performing an assurance engagement on banks, you have to consider the BOFIA, that's the Bank and Other Financial Institution Act of 1991. If you are providing assurance services for an insurance company, for example, you have to also consider, as you're considering the IFRS, you also have to consider the Insurance Act of 2003. Now, appointment of auditors in Nigeria. I'm sure you have seen this under your corporate governance and ethics. So every company shall at each annual general meeting appoint an auditor or auditors to audit the financial statement of the company and to hold office from conclusion of that until the conclusion of the next annual general meeting. So basically, an auditor usually appointed where in an annual general meeting. Some people have it at the end of the year, depending on different company policies. Some have it at the beginning of, it's usually after the end of the financial period, basically. So that's when you have your annual general meeting where they get to discuss what's the performance, how can we do better, how do our shares perform. All those things are usually done in what are the budget, what's the budget for next year, how is it going to be approved, and all that. So all those happens in the annual general meeting. So at any annual general meeting, a retiring auditor, however appointed, shall be reappointed without any resolution being passed, unless is not. So that means an auditor can actually be reappointed. You can be reappointed as an auditor, but basically at the end, at every annual general meeting, you are either reappointed or if you are not qualified to be reappointed, which we are looking at now. So shall be reappointed without any resolution being passed, unless it's not qualified for a reappointment. That's when there now has to be like a resolution. So you can be reappointed without a resolution, except you're not qualified for reappointment. A special resolution has been passed that the meeting appointing appointing some other person. Yes, if they don't want to continue with you now and they want a new person, so a resolution is going to happen in that case. And then, if the auditor has decided to retire, resign rather, not retire, resign from that particular auditor, which you would have given a notice in writing, not oral notice, you would have given a notice in writing. It has to be formalized. As we go into the audit, you see things like audit documentation, all these things, they are key. Documentation is a key aspect of audit. It has to be in writing. It has to be in writing. So in a case where no auditor is appointed or reappointed, directors may appoint a person to fill the vacancy. That if there's no auditor at that particular point to reappoint, maybe they've not gotten someone to replace. If they've not gotten someone to, 1 minute, please. Okay, so if they've not gotten somebody to replace that particular auditor, and if the former one does not want to be reappointed, then they have to find someone else to fill the vacancy. So you may have to read some of all these things. Most of them are important stories that you need to know. Then we'll be looking at the key aspects in the class. So basically, you need to know that like they used to say, class is 40%, or what happens in class is 40%. but majority of the work, majority of preparation has to be done by you, because there are some in-depth details and basics that there may not be enough time to actually cover in the class, that you have to read by yourself and do your own research and get your understanding in order. So in principle, the remuneration of the auditor is set by whoever appoints him. So if it's the director that appointed him, it's going to be set by them, and if it's the shareholders, it's going to be set by them. However, in practice, where the shareholders make the appointment, it is usually to delegate. So they usually delegate, even if they are the one that's supposed to set the remuneration, usually for them to delegate to the board of directors. That's the responsibility of the audit remuneration. And the directors are likely to be more familiar than the shareholders with the nature and scope of work involved in the audit process. That's because they're the one that prepared it in the first place. And so the appropriate level of fees for that particular work. So because they know the extent of maybe transactions that have gone through throughout the year, and knowing that, okay, if an auditor comes, this is the extent of work they're going to do, they can ask, okay, based on our judgment or what we think, then this is what you are going to do, or this is going to be the extent of the work. This will be the remuneration, right? So the board of directors may delegate the task of recommending or approving the audit fee to the audit committee. I'm sure you'd have seen some of these things in your corporate governance and ethics. Removal of auditors in Nigeria. So that's that about the appointment of auditors in Nigeria. The removal of auditors in Nigeria, according to section 362 of the CAMA 1990, right? So in certain circumstances, the directors are empowered to appoint auditors. However, it may not be appropriate for the directors to have the power to remove the auditor from office. For example, it will be inappropriate for the directors to have the power to remove the auditor because there may be disagreements between the directors and the auditors about an item in the financial statements or about the conduct of the audit. And this happens a whole lot in practice. It happens a whole lot where while you're auditing an item of the financial statement, and then you see some maybe material misstatement or even some presentation issues that has to be reclassified, the directors may disagree with you on that. They might say, no, you're not going to change that, or this is not in line with how we want it to be presented, even if you are doing your job according to the standard. So there's always that possibility for disagreement between the directors and the auditors. So that's why they can't really confer on them the authority to remove them, because if they can remove the auditors as they like, I mean, when there's any disagreement, before you know it will just be, the auditors will just be there hanging, and they're going to remove them by and then it could also present some threats. Okay, we'll look at threats as we go on, so let me not jump into that. So let's continue. The directors could silence the auditors by dismissing them. So we don't agree with your journals, we don't agree with your adjustment, we don't agree with your reclassification. Oh yeah, we are sacking you from being auditors. So clearly, it will be more appropriate for the directors to recommend the appointment, recommend the appointment of new auditors to shareholders, and for the shareholders to decide. So basically, the directors cannot remove an auditor. He would have to recommend a new one. And recommending a new one, and when he recommends a new one and there's a resolution to appoint a new one automatically, it means that the other one is out. But then he just removed that absolute power and absolute control from the director, so they don't infringe on the independence or the objectivity of the auditors. Now, if the auditors resign from the office, they're required to give their reasons to the shareholders and notify the authorities of their removal. So, like we said, if an auditor wants to resign, he has to give a notice in writing. He has to give a notice in writing, which is going to include the reason why they want to resign. In Nigeria, it's the ordinary shareholders who are able to dismiss the auditor. Shareholders, keyword shareholders, not the directors, shareholders. That at a resolution when they've gotten a new auditor, passing an ordinary resolution with special notice at the general meeting. When this occurs, the company shall within 14 days give notice of that fact in a prescribed form to the commission, and if a company fails to give the notice required, the company and every officer of it who is in default shall be guilty of an offense and liable to a daily default fine of 100 naira. I'm not sure 100 naira is what it is in practice right now because it seems so small. That one you may have to like find out. But then for your examination purpose, just know that default fine of 100 naira per day, right? Then you can further go into research of that if it interests you, right? Okay. Resignation of auditors in Nigeria, according to KAMA 365 and 366 of section 365 and 366 of the KAMA 1990. So an auditor may choose to resign during his period of office. And some of the reasons why an auditor may actually resign are: number one, a consistent lack of integrity. When a consistent lack of integrity is demonstrated by management and or those charged with governance, that's when they have noticed a significant inconsistency in their integrity. Now, it is the responsibility, okay, that's part of what you have done in your introduction to audit, the responsibility of the management to prepare and present financial information, ensuring that it's free from material statement and all those things like that. But if the auditors now identify that these guys are not true to their own responsibility, they're not keeping their own part of the responsibility that they should, that maybe they are involved in the perpetration of fraud, the management themselves, maybe they are involved in perpetration of fraud or they are involved in money laundering and their integrity is at stake, then an auditor can decide to resign. When a significant fees remain unpaid, we're going to look more about the implication of when an audit fee is unpaid as we proceed in this particular discussion, because it can affect the independence and the objectivity of the audit, because it now has financial interest. It cannot be able to like be as objective as it should, because it knows that its money is being held. We'll look more about that. We'll look more into that as we proceed in the audit. Also, the audit firm can no longer maintain its independence. So if the auditor feels like with the way things are going, it seems like we've lost our independence, we cannot objectively evaluate the financial statements or the financial information of this particular client, because maybe we have financial interest, or maybe because we have there's too much intimidation, for instance, or there's too much self-review training because they are too small to handle the audits of that particular client, and then because they are too small to handle the audit of a particular client, they believe that they cannot do the job well, and all those different reasons. To look more about independence as we proceed, they can decide to resign. And also, when the auditor believes that the client is no longer profitable for the audit firm, so the auditor now, if they feel like, okay, because of the extent of work we are doing for you, we want a revision to our audit fee. We want it to be maybe from 5 million to like 10 million, and the client is saying, no, we don't have 5 million to pay you again. We want to pay you 3 million. So if it's not favorable for the audit firm, they have to resign just so they can maintain their independence, knowing fully well that they don't have any they're not biased for whatever reason, like they're not biased for whatever reason, because knowing that you're not even paid the way you should be paid, or you are not in agreement with the amount they are paying you, and you are not comfortable with that, it could create some independence issues that might undermine your credibility or your objectivity to do the job. So, however, company law provides a certain guidance and certain safeguards to ensure that the shareholders are made aware of any relevant circumstance relating to the auditor's resignation. Basically, like you said, it has to be in writing, and the shareholders have to know exactly why they are resigning. The procedures for the resignation of the current auditors are: one, the resignation should be made to the company, at its registered office. Now, if you see in a financial statement, you see all these things: registered office, company secretary, all those like that. So it has to be made to the company as a registered office in writing is not an oral resignation. I'm not doing again. No, it has to be professional. As professionals, you have to write. So the company should submit the resignation to the appropriate regulatory authority. And the auditor should um, prepare a statement of the circumstance. This set out the circumstance leading to the resignation. So basically, the explanation as to why he's resigning. If the auditor believes that these are relevant to the shareholders or creditors of the company, that if they believe that it's relevant, so they can go into details of why exactly they're resigning. And if no circumstance exists, the auditor should make a statement to this effect that there is no reason, or maybe they can't disclose, or whatever it is. I've not seen a resignation letter on another letter of resignation before, so I can't really say how it looks like. But then this just tells us that a statement of circumstance might be required, as if the shareholders want extra explanation as to why they're resigning. But if it's not necessary, then they just state that there was no reason for that. So the commission, we talked about this before, send the statement to the commission within 40 days, and then the we talked about the fine of 100 naira. All those, just read them up on your own. Eligibility to act as an external auditor. External auditor. Okay, so like you said, under the definition of audit, so audit is an independent examination carried out by a qualified individual, qualified person, qualified accountant. So you can't just show up as an external auditor. You have to be eligible. So so part of what informs the eligibility you can see here are the regulation by the audit profession. So eligibility to act as an external auditor is usually determined by membership of an appropriate regulatory body such as our ICAN. So which is why you're going through all of this audit. And there are a lot of information you're going to come across here that if you didn't go through this class, you may not really understand. For example, we have a lot of questions about audit opinion, qualified and non-qualified report, how the general public believe that a qualified report is a good report because they do not have this knowledge that you are getting here. But you as a professional have this knowledge. So that's part of what makes you qualified, because you understand the in-depth of audit. The auditing ICAN is putting you through everything, every knowledge and skill that you need to become a qualified practitioner or a qualified accountant. To that's what they're providing for you. So the role of such regulatory bodies normally includes following: offering professional qualifications for auditor, that's ACA, to provide evidence that the auditor possess a minimum level of technical competence. There's a basic knowledge that is expected from an auditor. Basic. Let's say you don't even have all the experience, don't have like 5 years experience, or even 2 years experience, or 1 year experience, or 6 months experience. You should have a basic knowledge of auditing, basic knowledge of how things are done. So that's one. Minimum level of technical competence, which is what ICAN is doing. Establishing procedures to ensure that the professional competence of the auditor is maintained, and they do this through their own ethical standards. So ensuring that the audits are performed by a fit and proper person, aka a qualified person who acts with integrity. Integrity is key, because if the managing partner has to make a decision based on the work that you have done, the sufficient and appropriate audit evidence that you have gotten, but let's say and you lack integrity in the sense that you state that you have performed a particular test and you did not perform that test, and a decision is now made by the managing partner which happens to increase the audit risk, that becomes a problem. So integrity is a key word for an auditor. If you want to go into audit, you have to be full of integrity, in the sense that you have to be honest about your audit procedures. You have to be honest about your job, basically. Also requiring that the members carry out their audit work in accordance with appropriate technical standards, for example, in accordance with international standard of auditing, which is what you're going to learn here. Because when you're going to audit, You are not just going to audit based on your feelings. You are going to audit based on standard procedures, standard on how things should be done in an audit. Also, I can ensure that the auditors are professionally competent by ensuring that auditors remain technically competent and up to date with modern auditing standards. For example, following a program of continuing um, professional development. So the auditor has to be well informed about what's happening in auditing. For example, you can't call yourself an auditor at this, especially in 2021, if you don't understand the implications of COVID, for instance, on an audit, on the scope of the audit, on the audit procedure that will be conducted or that will be performed, on even on risk, identifying risk area, because COVID has changed a lot of things about the about the audit profession. You can't travel to a client's place again to evaluate documents physically. So most of them they may have to send you scanned copies of their source document. What are the additional tests that you have to conduct? So the IFAC, if you go online now, you see a lot of what do they call that thing again? Guidelines on how to conduct an audit, especially in this COVID era, and even going forward, because COVID has changed a lot of things that may remain changed and may remain changed even to the future, you know. So an auditor has to be in the know of all these, be in the know of going concern, be in the know of how to conduct confirmation now, to be in the know of getting written representation and all those things. So an auditor has to be very current with the development of it, of that this particular time and circumstance. An auditor has to be advanced in Excel. Now auditing is now shifting towards data analytics, for you to know the figures are important, for you to know a lot of things here, evaluating the risk. A lot is now involved in audit, unlike the way it used to be. So it's no more auditing as usual, if I'm permitted to say that. So the auditor has to be in the know of all of these things, right? And it's also a continuing professional development that is expected from whoever says that they are an auditor. And I think I can provide all of these, that they have seminars and all for this continuing professional development. So I can also provide procedure to monitor and enforce compliance by its members with the rules or regulatory body. Yeah, so this includes rules and procedure for the investigation of complaints against members and the implementation of disciplinary procedures where appropriate. So there are cases where most people licenses are taken away from them because maybe it has gotten to ICAN that they are not acting independently, but they are just performing audits and it's not according to the international standard of auditing. So I can also maintain a list of registered auditors, which is made available to the public. Registered auditor. Now, this registered auditor we're talking about like a firm of child accountants. Even an individual as well could be a registered auditor. That if you have your stamp, then you can serve as an auditor. But we that we don't have stamp, where we are working under the umbrella of an audit firm who has a stamp, right? Okay. Such a system that is established by the ICAN is known as self-regulation. In such system, the regulation of auditor is carried out by their own professional bodies. In this case, we have ICAN. With the right ACCA, also they have their own regulations, right? Under ACCA and all. Then we also have regulation by the government. So the government may appoint a public body with a similar responsibility to a regulating professional body. The public body may therefore establish rules and procedures for approving authorizing individuals to perform audit work, ensuring that authorized auditors have the necessary minimum skills. I'm not sure I've seen any of this in Nigeria. I think mostly the ICAN regulation that I have experienced. So, but then you have to know all of these things You have to know all of these things, right? In addition, it's usual for statute law to establish that certain individuals are ineligible to act as external auditors. You need to know those that can never act as an external auditor in the context of a given company. Now, if they are member, even if they are a member of an appropriate regulatory body, and we will be looking at them, right? So in section 358 of CAMA 1990, the following individuals are prohibited by Nigerian law from acting as the auditor of a company. So they can never act as an auditor of that company while they fall under this category. So the first one is an officer or a servant of a company. So if you're an employee in a company, you cannot be the external auditor, yeah, because you're already internal. So that's even common sense. Because you're already internal, you cannot serve as an external auditor. You cannot provide a statutory audit because you're an employee of that particular company. First of all, you cannot be independent because you are getting a salary from them and you are under their management. So you cannot serve as an external auditor. And then a person who is a partner of or in the employment of an officer or servant of the company, a partner, a board of director cannot act as an external auditor. His own responsibility is just to prepare the financial statements in accordance to relevant standard, ensuring internal control, ensuring that the control can identify and also um, identify and prevent fraud, right? And also a corporate body, a company cannot act as an external auditor of the company. It has to be an audit firm or a firm of accountants. Okay, so I think we should take a 5 minutes break. A 5 minutes break. Um, a 5 minutes break is going to end. While if you have any questions, you can ask. If you have any questions, you can ask. Are we together here?
Yes, we are.
If you have any questions,
Now,
okay. There's none. Okay. So let's have that 5 minutes break. You can go and drink water. You can just move your legs. Just do something. The 5 minutes already. So are you all here? Kolako, are you here?
Yeah, I'm here.
Okay. Okay. So welcome back to class. Hope your break was productive as mine. Okay. This is where we are. Okay. We've talked about the regulation by government, which I say you should read on your own because I don't get to see that in practice. Maybe in Nigeria, I don't get to see that in practice. And then we also talked about those who are not qualified to act as an auditor, which includes the staff of the company, even a company itself, or even a partner in a particular company in employment. So let's look at the duties of an external the duty of an external auditor. And these duties are what's going on? Okay. So the duties of an external auditor, the primary duties of an external auditor. So the primary duty of an external auditor is to examine the financial statement. That is their major work. To examine the financial statement and also to issue an audit report which sets out the opinion of the auditor. So to issue an auditor's report on the financial statement, which is then presented to the shareholders together, with the financial statement. So an auditor's main primary work is to examine the financial statement and come up with an audit report which contains his opinion on the financial statement, primarily for the shareholders. Primarily for the shareholders. Right. The auditor's report we set out the audit opinions as to whether or not the financial statements give a true and fair view. Like I said, these are keywords you're going to see in an audit report. So I think I would like to give you an assignment today to try to download an annual report. I think you should be able to get one from Dangote Group of Companies any year, just not any year. If you can get the one for 2019, it should be published by now. The one for 2019, just go through the audit report, because the audit report has changed. So I want to be like using the new audit report format. So you can check the 2019 audit report for you to like see all of these things by yourself and for yourself. So an auditor's report will contain what like give a true and fair view or present fairly the financial position and performance of the company, and have been prepared in accordance with the applicable financial reporting framework, which is our what suitable criteria, right? In Nigeria, Section 360, 1990 requires the auditor to perform to also form an opinion on the matter stated in Schedule 6 to 1990 as provided below. So they also have to express an opinion as to whether they have obtained all the information and explanation, which to the best of their knowledge and belief. So you can see subjectiveness here, which is the reason why audits cannot be absolute. Which to the best of their knowledge and belief, that's judgment, were necessary for the purpose of their audit. They also have to express an opinion whether in their opinion the proper books of account have been kept by the company so far as appeared from the examination of those books, and proper returns adequate for the purpose of audit have been received from branches not visited by them. That will apply in the case of a group a group, or sometimes even a company that has different branches. For example, a company can be in Lagos and have branches even in Nigeria, and it may not be a parent and subsidiary relationship, it might just be the same company. And you may not be able to, as an auditor, maybe travel from, maybe they have across 5 different states. You may not be able to go to all those 5 different states, because most often, I'd be more likely than not, those other branches will be giving reports to the major to the main office, and you'll be able to find some of those documentations and all. Although you have to get some written representation about some items if need be. So they also have to state whether the company statement of financial position, unless it is framed as a consolidated profit or loss account, are dealt with by the report, agree with the books of accounts and return. So when we're talking about book of accounts and return, we're talking about the ledger, talking about the primary books of accounts, all your invoices, source document basically. Do they agree with the book of accounts? So they also have to say whether in their opinion and in the best of their information and according to the explanation given to them. So as an auditor, you can't work without explanation, because you need a better understanding of what happened during the year. Like I said, you are coming to audit for 3 weeks, the work that has been done for 12 good months, 365 days, and you are coming to spend 15 days for an audit. You need all the explanation that you can get, and although you're going to do your own walkthrough analysis to be sure that what they are explaining is really what they are doing in practice. So these are still part of the reason why for the subjectiveness in audit, right? So whether in their opinion and the best of their information and according to the explanation given to them, the said statements give the information required by the act. in the manner so required and give a true and fair view, blah blah blah. That one is talking about the presentation of different financial statements or the financial statement, be it an individual or consolidated. So the auditor has to state if any of those above requirements are not met. Now, the outcome of the statutory audit is an opinion. It is an opinion. It is not it's not conclusive, like we said. It's an opinion on the truth and fairness of the financial statement. In the introduction to auditing, there's a lot of explanation as to the meaning of the truth and fairness, truthfulness that is correct, and fairness that is presented properly, right, of the financial statement. The word opinion implies that the auditor has applied his professional judgment in reaching its conclusion. So the more experienced an auditor is, the better the better he is at expressing an opinion. The more experience he is, the better the opinion will be. I hope it's safe to say that, because based on your level of experience, there are some things that you may not see that a very experienced person will see. Like someone who has been auditing for maybe 20 years and knows some maybe fraud patterns. It might be even be easier for them while they are auditing, identify some fraud and all that even you as a new person may not be able to see, because you feel like it's done properly now, Abby. There's no mistake and all those things. But from experience, you hear things like you have to audit properly the repairs and maintenance. Repair and maintenance is a high risk area, and maybe depending on where the client and an experienced auditor says that their cash and bank always is a risk area anyway. They get something like maybe their cost of sales is a high risk area, or maybe their retirement benefits is a high risk area, depending on their experience with the client. So the more experienced you are, the more should I say, the better your audit opinion. Although it's not something that you are going to do as an audit trainee or as an audit senior, even as an audit manager. If you go back to your notes, your introduction to audit notes, so there's the structure of an audit firm, in place in structured organization. So you going to the field that doesn't make you the one. You're not the one that will sign the account. You're not the one that will do the review. There'll be someone reviewing if your audit firm is actually properly structured, right? So the right of an external auditor, your rights as an external auditor, you need to be armed with all these rights when you're going for any audit, right? An external auditor have certain statutory rights to enable them to perform their statutory audits. The main rights of the Auditor per Kama 1990, Section 360 and 363 include the following. Number one, you have the right to access all, not some, all books of account and record at all times. Anytime you make a demand for any book, it has to be given to you. If you make a demand for a source document, that's to be given to you, or else that becomes a limitation of scope. We'll look more on that when we're discussing reporting. So you have the right to access their book, which is part of the reason why as an auditor, we will look at that under the ethics of an auditor. More reason why as an auditor you have to uphold the principle of confidentiality, because if a client is giving you that much access to their books, your mouth has to be controlled in the sense that the word must not go out as to how that particular client is keeping their record, how much they have, how much revenue, because you'll be exposed to all these things. You know what their revenue is, this is 1 billion. You know how much they are paying staff. You know how much they are paying this. But you have to uphold confidentiality and not open your mouth to go and tell the whole world that this is what is obtainable in that particular client, right? And also you also have the right to all information and explanation from management necessary for the proper conduct of the audit. So if you are checking the source document of the book of accounts, or like the trial balance, the GL now, for instance, and you don't understand a particular item, you have the right to walk up to the management and say, excuse me, I'm not sure I understand this posting. Why is your expense showing a credit balance when it should be a debit balance? Can you explain to me all these reversals? Why is there so much reversal? Why is there so much reclassification? What is causing these errors? Why is this not posted properly? Why is this posted here and not on another leg of the financial statement? So you have the right to all the information and explanation, right? You also have the right to receive notice of all the meetings of the shareholders, such as the annual general meeting, and to attend those meetings. So auditors are always invited to this annual general meeting. You have to be there. You have to be at the annual general meeting. You have the right to receive a notice of the meeting. The right to speak at shareholders meetings on matters affecting the audit or the auditor. So as an auditor, when you're in the annual general meeting, you have the right to speak up on matters that relate to the audit. This can be important when the auditors disagree with the directors of the client entity and are unable to communicate with the shareholders effectively by any other method. So let's say there's a disagreement on an adjusting entry, for instance, and then the management are not agreeing, and the accountant and the auditors too are not agreeing, and it becomes so severe, and let's say somehow the account was signed and you have to come and talk about the key audit issue, because when you see an audit report, you see a place where it's written key audit issue. There's a segment called key audit issue, so you may be called upon to discuss more about that, you know, to the shareholders, if that's the best way to reach them, if you've not been able to reach them in any other way, right? If the company uses written resolution, the auditor should have a right to receive a copy of all resolution. Basically, you have access to everything that happens in the meeting. Responsibility of management and those charged with governance. So with respect to the audit, and contrary to what many members of the public think, now we'll look at this more when we talk about the expectation gap. You see some of all these things. Is it the management with respect to the audit, and contrary to what many members of the public think, it is the management and those charged with governance who are responsible for, number one, prevention and detection of fraud. Preventing and detecting fraud is not the primary responsibility of an auditor. You'd have seen this in your introduction to auditing. It is not the primary responsibility of an auditor. Yes, it can happen while the auditor is conducting his audit. Maybe he's doing an audit procedure and then he discover, it's not as if he went looking for it. He discovered while he was conducting that audit, while he was carrying out an audit procedure. That is okay. That's a secondary objective. It is not the primary. It is not the primary objective of an auditor. The primary responsibility for preventing and detecting fraud is on the management. A lot of people in the public do not understand this, and this is what creates an expectation gap. This is what makes them feel like auditors are not doing their job, or there's no need for auditors, because some companies fail after they have been audited. It's part of this lack of understanding that those expectation gap exist. Those charged with governance and management, aka the board of directors, are also responsible for preparing the financial statement. It is not the auditor's responsibility to prepare financial statements. It is not the auditor's responsibility to prepare financial statements. They are there to examine the financial statement. If at all an audit firm has been engaged to prepare a financial statement, the same team should not be involved in auditing. This is to preserve their independence. We'll look more about the threats as we proceed in the audit, right? It is also the responsibility of the management and those charged with governance to design and implement effective internal controls. For example, authorizing payment above a certain amount, monthly bank reconciliation, and a monthly trade payables control account reconciliation. So it is the responsibility of the management of those charged with governance to say, hey, before 5 naira leaves this company, so has to prepare, so person has to authorize, so person has to approve before the money goes out of the account. It is the responsibility of the management to ensure that it's not everybody that can sign the check. There has to be authorized signatories to the check. Not everybody can sign a payment voucher. There has to be authorized individual depending on the limits of each individual. So an account accountant limit might be from maybe 100 naira to 20,000. Another accountant in that same company, the limit might be from 20,000 to 50,000 that they can sign. All these things has to be set by the management. When bank reconciliation is supposed to happen, how the auditors are supposed to do it, all these things are set by the management. So this is governance. It's not the auditor's job. Our job is just to examine the financial statement to be sure that they are free from material misstatement. And if you look at an audit report, like I said, you should go and get an Dangote's audit report for 2019 and just try to breeze through. You will see that these things are stated in the audit report, and the reason is to reduce the expectation gap, which is the misunderstanding of what audit is about that the public have about audit. So because the auditors now know that a lot of public people in the public, or the public actually, are very ignorant about their job, what they are expected to do, because the public expects the auditors, for instance, to prevent fraud. The public expects them to detect fraud. The public expects them to, be responsible for some of these controls, and they will be like, why didn't you ensure? It's not our job to ensure all these things. So this is why the audit firms now took it upon them to educate the public by including these responsibilities in the audit report. So in an audit report, you will see the responsibility of the auditors, and then you also see the responsibility of those charged with governance. The responsibility of those charged with governance. Okay, so now the management are also responsible for providing providing auditors access to relevant information that relates to the presentation of financial statements. Now, financial statement, in secondary school, or not even secondary school, even university, like, we're only taught about the financial statement, the figures in the financial statement. But mind you, before you can come about the figures in the financial statement, there are a lot of other small figures. May not be small. There are a lot of different sizes of figures that makes up that what we see in the financial statement. And you see a lot of that in audit. You see a lot of that. That's when we're talking of things like the general ledger. You see what it looks like in real life, not the general ledger definition that you use for control account or whatever. You see what it looks like. You see what it looks like. You see what it looks like in real life when you are in audit, right? You see some of all these things you are reading in school. You see them in an audit. So they are responsible for providing access to information relevant to the preparation of financial statements. They are also responsible, that's the management, are also responsible for providing additional information relevant to the audit. So anything auditor is asking related to the audit, they have to provide that information. They are also responsible for providing unrestricted access to persons whom the auditor needs to access to in order to complete the audit. For example, you are auditing payroll. They have to provide you the access to the HR manager or the HR person that is in charge of preparing of that payroll. Or you are auditing whichever area you're auditing, the relevant individuals, the individual that are in charge of that particular department, you need to have access to them. So the management that have to provide, it is their primary responsibility to provide you access to all these individuals. So actually, typically what happens in an audit when you get into an audit engagement is that they will take you around. They'll take you around to meet the necessary individuals that are in charge of like different departments. They'll take you around to get to know who's the head of audit, who's the head of finance, who's the deputy financial manager, who's the cashier. That is relevant to you. Who's the account officer? Who's the what? Who's the HR manager? Who's the whatever? They'll take you around to um get to meet all of these people. They're also responsible for. They're also responsible for. Let me see this chart. Kindly end meeting. Okay. They're also responsible for. Sorry about that break. Okay, so they're also responsible for providing written representations to the auditor at the end of the audit. So we're going to look more. We're going to look at audit representation, written representation as time goes on. There's a standard for that. Look at that as we proceed deeper into the audit. It's a very, very interesting journey we are getting into. And I really hope you get to work in an audit firm. I don't know if you are already, but if you are, I hope you're enjoying it. And if not, I think you should need to like explore that particular opportunity. So let's talk about okay, I think you can read this on your own: professional regulation, the ISA, the IFRS, um, accounting and audit profession. All these are really important. So this is talking about the IFRS as a global accounting standard, and also the ISA as a global accounting standard. Okay, let's look at this. So the harmonization of the accounting and auditing profession, because you can't talk about auditing, you can't say you're an auditor if you don't understand what happens in accounting. Like you need to know both your ISAs and your IFRSs as well. You need to know the both of them. So the IFAC is an international regulatory body for the profession, but each country has its own regulatory regime for auditing, which may not necessarily apply the same principles of audit behavior as those used by IFAC. I think the one in Nigeria is FRC and um, Financial Reporting Council of Nigeria. Yeah. So the same argument that have been made in favor of the universal adoption of international accounting standards can be made in respect of other regulatory aspects of the auditing and accounting profession. So yes, when we're talking about IFRS, it wasn't always IFRS. Every country used to have their own GAAP. Nigeria used to have their own GAAP. I think it's NGAAP, Nigerian Generally Acceptable Accounting Policy. Yes, Nigeria used to have, different countries used to have their own, but IFRS now came to unify everybody so that if you are in a different country, you should be able to understand the financial statement of another country, right? By just evaluating their financial um, statement. So it reduced all those the cost of converting your, for example, you're a Nigeria company, and then some a foreign company wants to buy part of your shares before the IFRS. So you may have to convert your financial statement to something that those international investors may would understand. But IFRS came to unify everything, making it easier for even an external person to understand what a financial statement entails, regardless of the country. Except US. US uses their own GAAP. They've not adopted IFRS. Okay. So now this is the same thing that happened with the ISA. So different countries used to have their own ISAs. I think um Nigeria one is NAS, used to be NAS, National Accounting Auditing Standard. National Standard, or is NSA? I think so. Yeah. But in my generation, did not meet that, and that is none of my business. But you need to know that it is necessary your for your knowledge. But then at this point, what is more important for you to know is the international standard on auditing, right? So which is what IFA came to like unify. So what's the advantage of applying unifying this accounting auditing standard? So this includes the advantages such as the adoption of global auditing standards. So the ISA is now a global standard, regardless of the country that you are in. You see the same ISAs, right? So that's why an auditor, an auditor or an audit firm in another country should be able to understand what you are doing in Nigeria and the auditor in Nigeria, because the standards are the same. Although there might be some local standards that may influence it, but then the standards are primarily the same. Documentation required may vary depending on the circumstance of the client or even the country, but then the documentation has to be there, making it easier for any audit firm, any other audit firm to actually pick it up and understand what you have done, right? Disadvantage of getting the unifying the auditing includes the problem of getting international agreement on auditing practices, and the need for many countries to change their local laws to bring it in line with the agreed international practice. But that has already been done. You can read some of this one just so you know. It just tells about the back and forth that went into unifying the international standards on auditing. Now let's look at the okay. Before I proceed, any question? I want to be sure you're following the class, please. Question.
Yes, yes, can I quickly ask one or two?
Okay, yeah, sure, please.
Yes, during when you're talking about the rights of the auditor, you write what is the way of the management to do in terms of that the manager is
I didn't get. Are you close to the fan? I can't really hear you.
okay. Can you hear me now?
Yes, I can hear you now.
In respect of prevention and detection of fraud that you mentioned earlier, that is not the primary role of an auditor.
Yeah.
If an auditor is appointed because of
Okay.
a certain fraud that the management think has happened in an organization,
Okay.
so how can we not place that? Is the auditor still not supposed to detect that kind of fraud?
Okay. So let
Because
me quickly answer.
I think we have I think we have external auditor now that okay, maybe they are supposed to be coming periodically, and there is this maybe the management suspects a fraud going on in an organization, and they invite the external
Okay.
auditor in. So the law
Okay.
is supposed to be that all their roles should include detection of fraud if there is any, and if there is none,
Okay.
to
Okay.
advise the management to put some internal control in place to prevent maybe the loopholes or where fraud can be perpetrated.
Okay. So to answer your question, that that type of work is under forensic audit. Forensic. It is not a statutory audit. That is under forensic audit. That's when there's a fraud or the management has been tipped off that a management has been tipped off. The management has been tipped off that okay, there's a fraud and we want an auditor, the external auditor to come in. The external auditor coming in for that particular job, it is not a statutory audit they are coming for. They are coming for a forensic audit. Forensic audit. Now that forensic audit is about detecting financial crimes like fraud. That's a different type of audit. It is not a statutory audit. It is a forensic audit that the management calls up and say, okay, we suspect that this is happening, so come and check. So when they check and they didn't see anything, of course they're going to give their report that this will check, and this is how you can improve. I've been on a forensic audit before, and practically we had access to everything because the management was also tipped off. So we had to check like a lot of things. We checked file staff records, we checked different things. I think the management was suspecting that the accountant was stealing some money, and the internal auditor too. In the internal auditor was stealing money, so we have to come and check that, and we identified some of this fraud that went on. But I really don't know the penalty that they gave the auditor, the internal auditor then. But then that was a forensic auditor. We're not going as statutory auditors, we're going as forensic, FORENSIC. I'm sure you know that forensic auditor, right? Yeah. So I hope that answered your question.
Yeah, sure. You did. The second question is about keeping substantial record to be able
What is it?
to
Please
keeping
come again.
substantial record, that will be sufficient for the auditor to carry out their duty.
Okay.
So, if at the point of engaging an auditor, that the auditor now uh, uh, okay, look into the record and see that the company that they're about to is not keeping enough substantial record. What do they do at that time? Do they reject that job or they advise about what needs to be done so that they can carry out their job?
Okay. So when you are called to audit a firm, Or I'm saying, oh, sorry about that. Not audit a firm. When I call to audit a client, and you've done the whole agreement, engagement, process. But before then, before the whole term of engagement and stuff is signed, there is, as an auditor, you'd have done your background information. You'd have done your own background check. Okay, Mr. ABC or company ABC want me to audit his company. First of all, what are all the information we could get about this company ABC? Because as an auditor, you wouldn't want to get into a messy situation where your independence will now be in your independence will not be in question because something not the like we said, the integrity of the management is in question or something. So before you can accept any engagement, you have to first of all do your own background check. In fact, that's the first thing an auditor would do when they are called upon to like audit before the whole agreement is signed. You have to do a background check. Who is this company? Who are the management of this company? As much as possible public information that you can get, you have to get them. As much as public information you can get. Then you also have discussions with the management. Any information that they need to let you know before the engagement is signed, they provide the one that they can provide, and all. And if is that okay, they say that we have this accounting issue, some things are not in place and all that, doesn't mean that you can accept the audit. Now it's not a function of, okay, does the audit firm want to accept that particular audit? Because there has to be an acceptance. So if the auditors do their check and say, okay, the risk in this particular area is manageable, it's not something that would taint their own reputation as an audit firm, and they decide to go ahead and do the auditing, they will examine the records that they can examine. So as long as, now we have to understand the nature of when we say that, okay, they are not documentation and stuff. Is it that they are being intentionally deprived, the auditors are intentionally deprived of that particular information, or their record keeping is a mess? Yes, we understand, but they can still provide the supporting documents that we can see it, that we can see, because even a basic company, right? A basic company or a basic accounting department has to have files. I mean, if you can't substantiate the figures in the financial statement, then what are you doing as an accounting department? So if it's significant, now the auditor can now decide. It can now inform the auditor's opinion and say, okay, in our opinion, we believe that blah 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 is materially misstated because maybe we've seen a lot of source documents that were inconsistent, materially inconsistent with what is posted in the financial statement or something. But then it doesn't still stop the auditor from giving recommendation. And auditors give all these recommendations in what is called a management letter. We look more into some of these things inside a management letter. So where they raise their issues and say, okay, we observed blah 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 blah. This is our recommendation. We recommend that you either, depending on the nature of the business. So it could be that we recommend that somebody else handles the account, not like you're like another individual joins the accounting to ensure that internal control is in place, or we recommend that maybe online invoices, like with this age of COVID-19, where some people cannot go and physically provide the invoices anymore, that somebody in another country can provide a service to you, and they cannot come and be wasting money on couriering physical documents, right? They can send you an online invoice. So all of these things, you cannot recommend that, okay, online invoices has to be kept maybe in a safe database, or they have to be printed out and put in a file so that when the auditors come, they can have access to it and sign off. All those recommendations goes on in the management letter. I hope I'll be able to answer your question. Hello.
Yes, hello. You've been able to. Thank you very much. Thank you.
Okay. So as you get into audit and you get to be a part of different circumstances, you have more understanding of how the auditing really works. It's not a cast in stone thing. As we said, audit is a function of judgment, judgment, where your auditor believes that he has carried out all the necessary procedures that he needs to come up with an opinion. Are we clear? clear on that?
Numbers. Yeah, I'm very clear. Thank you very much.
Okay. Okay. So let's continue. So we're looking at the professional standards. So we're looking at some of the auditing standards, right? So we're looking at the international standard setting process. You have to read that on your own. The preface of the international standard on quality control, auditing review, other assurance and related services. The IFAC is in charge of that. The IASB, that's International Audit and Assurance Standard Setting Board, Clarity Project, the ISA 200, overall objective of the independent auditor and the conduct of an audit in accordance with the international standards on auditing. That is what ISA 200 is about. So you should be able to say some of all the standard, know some of all the standard offered, right? Knowing that ISA 200 is the overall objective of the independent auditor and the conduct of an audit in accordance with international standards on auditing. So the international standard setting process, I'll just briefly breeze through this. So the international standard on auditing, ISAs, are set by the International Audit and Assurance Standards Board, that's the IAASB. So ISAs are set by the IAASB, International Audit and Assurance Standard Board, right? Which is also a part of IFAC. We know IFAC is the International Federation of Accountants. So the same thing that goes on under the IFRS, right, where there's going to be an exposure draft and relevant individuals or relevant professional bodies that to comment on the exposure draft, right? They comment on the exposure draft, then it goes back to the body. The comments are reviewed by the same IASB, that's the standards board, and then the draft is brought out, and then if it's an old standard, the new draft is brought out and amended, and if it's a new one that is required after the whole exposure draft and comments are received from the relevant bodies, they will not be used to form a new standard. So we're looking at different type of standards under the IASB, what they are responsible for, in addition to the international standard of auditing. So it's not only ISAs that are responsible for, they are responsible for other standards. So international standard on auditing is used for the auditing of financial statements. You have to take note of all the scope of this standard. So the ISA scope is the audit of financial, historical, because you know financial statements usually in previous year, right? Historical financial information, right? We're not auditing on a real-time basis as the transaction is happening today. We're auditing today. No. It's after 12 months, they'll call us together and say, okay, this is what we have done. Okay, come and audit what we have done for the past 12 months. So international standards on auditing is the scope is the audit of historical financial information. Then we have also international standards on review engagement. Remember, when we're talking about other type of assurance engagements, right? Can you remember? Non-audit assurance engagement, where we had the review, the agreed upon procedures, and we had the compilation, right? So there's a standard for the review engagement. Now that brings us again, I'm trying to link it again to when we're discussing about the element of assurance, where we're talking about suitable criteria. And I mentioned that suitable criteria depends on what is the subject matter, what's the nature of that particular assurance engagement. So in the case of a review engagement, now the suitable criteria will not have to be the international standards on review engagement. Do you understand that? So the suitable criteria for a review engagement is the ISREs, which is used in the review of historical financial information. Then if it's other assurance engagements, we now have international standards on assurance engagement. This becomes the suitable criteria. And this is used in assurance engagement other than audit or review of historical financial information. So if it's an assurance engagement that is not an audit and it's not a review, then the suitable criteria now becomes the international standard on assurance. Then we also have international standards on related services. This is used for compilation engagement to apply agreed upon procedures to information and other related service engagement. So compilation and agreed upon procedures. For compilation and agreed upon procedure, the suitable criteria in this case now becomes the what? ISRS, which is the International Standard on Related Services. Take note again. ISA is on the audit of historical financial information. ISRE is for review engagement. ISAE is for assurance engagement other than audits and review. Now remember we said compilation and agreed upon procedures, and they don't provide any level of assurance, so they don't fall into this ISAE. Under the ISAE, we're talking about other assurance engagement apart from audit and review. Maybe you are providing assurance on, as we said, corporate social responsibility, employment policy, environmental policies, and all those kind of things. That will fall under the international standards on assurance engagement. But for compilation and agreed upon procedures, it falls under international standards on related services. And then we also have the ISQC. ISQC is for all of the above. Now, QC is quality control. Yes, is also a major aspect of auditing. There has to be quality control. There has to be a department. In fact, for every engagement, there's a quality control person that's assigned to that job to ensure that whatever audit procedure and while the review is going on is done in accordance with standards. So it's that quality control person that will double check to ensure that the audit is actually done properly. And you get to understand that when we're talking about the audit risk that we are all trying to like reduce, that audit firms are trying to reduce. Okay, so it's the IAASB that prepares all those standards. Have them at the back of your hand or back of your palm, whichever one applies. Okay, so then let's look briefly about the content of or the element of any international standards on auditing that you're going to find. So a basic international standard on auditing contains, first of all, an introduction to that particular standard, the objective that the standard wants to achieve, the necessary definitions that are involved in the standards, and also the requirements that are to be applied relevant to the audit, and also other explanatory materials, which is for guidance only, like different, there could be conceptual explanations, and other explanations that is believed to be necessary for you, right? The SQC, that is International Standard on Quality Control, applies to all the IASB engagement standards. So the IASB is not only involved in assurance standards, right? Like assurance standard is that ISRE, International Standard on Auditing, and ISAE. But when we're talking about the ISRS, they are not assurance standards, but then you see the international standards on audits and assurance, um, International Audit and Assurance Standard Board that does that, right? So you look more into this one. The importance when you see things like should, when you see things like shall, when you see things like must, you know that you have to pay much attention to that. So you have to read all of that, right? So and also you need to note that regardless of the fact that yes, there's a standard, there are relevant standards, the place of an auditor's judgment too cannot be ruled out. For example, in the question that you asked me about a client whose books are not organized, the auditor has to apply his judgment to know the appropriate tests, the alternative tests that he can take in that particular instance. So the books are not organized. You are aware of that. You had already considered that before you signed an audit engagement. So you know that you cannot follow the standard to the latter, because the standard expects that everything has to be in place. But you know the nature of your client, and for whatever reason that you accepted the engagement with the client, you now have to apply your own professional judgment to know the appropriate procedures that you can take for that type of client, depending on their circumstance. So you have to apply your professional judgment. So judgment is key. As an auditor, auditing requires that you think, that you are a thinker, a critical thinker, that you are able to identify what is relevant and what is not relevant, what should be done based on your judgment, that you're able to connect your experiences together to reach a very solid judgment. So you need to read all these clarity projects together, clarity projects and all. So let's look at the new ISAs, right? New ISAs, International Standards on Auditing. Just a summary. So after the summary, we end the class, right? So let's start with ISA 200. Like I said earlier, you have to know your standards. You have to know the number and what they mean, the number and what they are about. Okay. So ISA 200. So the ISA 200 now sets out the overall objective of the independent auditors. It also explains the nature and the scope of an audit designed to enable the auditor meet those objectives. Now remember, when we were talking about the ISAs earlier, we said that it contains some basic components here. The objective, this is an introduction, objectives, definition, and also requirements, and maybe additional explanations where needed, right? So the ISA 200, which is the objective, overall objective of an independent auditor standard, has that as well. So it explains the scope, the authority, and structure of the ISAs, and include the general responsibility of the independent auditor applicable to all audits, including the obligation to comply with the ISAs. Right. This standard also includes requires an auditor to make disclosures, necessary disclosures where additional audit procedures are needed beyond what is in the standard. So this is giving room for more audit judgment. So not only are you going to follow the scope and the requirements of this particular ISA, if you believe that there are other procedures that are necessary for the audit, then it has to be an auditor has to factor that into his disclosure. He has to disclose that. And he also has to ensure that he has gotten sufficient appropriate evidence. We explained sufficient appropriate evidence earlier when we said sufficiency is about the number, appropriateness is about the relevance of that particular evidence obtained. So it also goes forward to say that ISA includes material explaining important concept based on an audit, such as it provides information about management responsibility, it provides information about also professional skepticism. Now before I move forward, I would like to talk about this professional skepticism. Now professional skepticism is we'll look more into that, like deeper into that in the future, but then just so you have a background knowledge of what it takes to be an auditor. Professional skepticism involves you having a questioning mind, having this inquisitiveness, having this curiosity. Why? Why was this done? What could be the implication of COVID-19 on the financial statement? What could be the implication of going concern on the financial statement figures? What could be the implication of blah, blah, blah? Why was this posted? When was it posted? What's the implication? So you have to have a questioning mind. Professional skepticism also involves you taking a position of assuming, coming from a place of assuming that something could likely be wrong in the financial statement. Something could likely be wrong. You should not be all trusting of any client. You have to be skeptical that there is the possibility of a misstatement, and you go in with that mindset that there's a possibility that these guys are hiding something. There's a possibility that these guys are misstating something, and I'm going there to ask questions. Why is this figure like this? Why do you have a repair and maintenance of 15 million in a particular transaction? Don't you think that should be classified? Not even don't you think, that should be classified because it's a capital, it's a capital expenditure. You know, you have to be very skeptical. You have to be very skeptical. And one of the things that informs skepticism is the extent of knowledge and experience that you have. You can't be skeptical if you don't have knowledge. For example, you can't be even, let's bring it to like a basic human experience. You can't be skeptical about maybe a a thief, for instance. Your level of skepticism about a thief will be different from someone who has actually stolen before. A thief will be more skeptical about an individual who is a thief than you who have not stolen before. Than you who have not stolen before, or you who have not had friends tell you about how criminals or almost rob them, or you who are not exposed to information as to how thieves really operate. So the level of exposure you have, the level of knowledge that you have informs your professional skepticism. It defines how skeptical you are going to be about items or elements or any information you are given by that client in the audit of the financial statement, right? So ISA 200 also provide information about professional judgment and the inherent limitations in an audit that you cannot avoid. For example, inherent limitation that you cannot do 100% testing because, I mean, loads and loads and loads and tons of transaction. How many are you going to test? You can't test all of that. 12-month transaction within a month is obviously not feasible, right? So ISA 200 give explanation about all the professional skepticism, professional judgment, inherent limitations of an audit. ISA 210 is about agreeing the terms of an audit engagement, right? So now the auditor is expected to perform specific procedure to establish whether the preconditions for an audit are present. Now, this is part of what I was saying about before you getting a client, before you even agreeing to the terms of an audit engagement, there has to be a background work done. There has to be your own fact finding before you can say, okay, yes, I agree to this engagement, I agree to the terms of this engagement, right? So these are some of the preconditions are determining whether the financial reporting framework to be used is acceptable, determining whether your clients are actually in compliance with the IFRS. Are they complying? Are they complying with IFRS for SMEs if they're under SMEs? Are they in compliance? You also have to determine, you also have to obtain management confirmation that they understand their responsibility for internal control, for preparing and presenting the financial statement, for also preventing and detecting fraud, right? So the management has to be, they have to understand their roles and responsibility before you can say, okay, now we can sign an agreement, we can sign the audit engagement, right? So ISA 580 was what I was talking about is about written representations, right? So the management has to provide a written representation. It has to be in writing, not like they're saying it with their mouth. It has to be in writing that they understand that they understand their responsibilities as management, that they recognize, that they understand and they accept their responsibility as the management in the audit, right? Then we also have ISA 260. 260 is about communication with those charged with governance. It provides guidance on how you are going to communicate to them, right? Communicate with them. So this standard requires that there is proper documentation of matters that are communicated orally. For example, I know the easiest way is via email, right? So when you have a discussion with the management, there has to be minutes, or there has to be like a mail that will be sent that, okay, as discussed, we reached blah 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 conclusion. Or you see that there could be some that you are going to include in your working paper. There just has to be proper communication. There has to be communication, or there has to be documentation of whatever is communicated, right? There has to be minutes of whatever is communicated. So it also includes the guidance and requirements on communicating any significant difficulties they encountered during the audit. This will form part of your observation. It has to be documented. It also involves provide information about communicating any significant matter arising from the audit that were discussed or subject to correspondence with management. All these things has to be documented, mostly in a management letter. All of these things, significant audit issues identified during the audit, limitations and significant limitation material. That's the word used in place of significant material limitations, material issues that were identified during the audit. So ISA 265, communicating deficiencies in internal control to those charged with governance and management. This is more like a substandard, not like it's of lesser value, but like like a subtitle, something like that. Not a subtitle, but I'm sure you understand what I mean. Like a follow-up standard to the ISA 260, because it's about still communicating with those charged with governance. But in this case, it's more specific in the sense that we're talking about communicating internal control deficiencies identified with those charged with governance. So the requirements includes ensuring whether what you're communicating with those charged with governance are material deficiency, that they are significant deficiencies, those deficiencies that you know that can lead to a material misstatement of the financial statement, right? So those are what you are going to, and you're not just going to communicate small issues, like you just identify maybe an issue of 100,000 and the materiality of that particular client is like maybe 3 million, and you are reporting issues of 100,000. I mean, it's not it's not material. So this gives requirements, this gives further guidance on what you can communicate to those charged with governance. There has to be significant deficiency. Like if you notice a particular system where the errors coming out, or the errors as a result of that system is about 5 million, about 10 million, and the materiality of that client is like 3 million. Of course, that is a very significant issue that has to go into your communication with those charged with governance. So it also provide guidance stating that every communication has to be in writing. It has to be in writing. Significant deficiency has to be in writing, and there has to be a description. You have to be clear. You have to be clear, not vague and say your system is not just working. There's nothing like that. You have to be clear. We identified a we identified a discrepancy between what is booked and what we saw in the source document as a result of ABC, and this led to a difference of 5 million naira, and the possibility that there could be more. You have to be very clear, and these are the part of the advantages that auditing does to you as an individual. It makes you clearer in your communication. You can't be vague, you can't be ambiguous. You have to be clear as possible about the issues that you have identified, right? So we're looking at ISA 320 as well, materiality in planning and performing an audit. Materiality is a key, should I call it concept, is a key concept that is considered in the audit of any financial statement. Is very key. So the ISA 320 provides a definition for materiality. So as an auditor, you get to understand what exactly fits the definition of materiality, right? Depending on the size and the nature of an item, and also depending on the circumstances. So ISA 320 provides information about materiality. It also provides guidance on the use of benchmark. Now, in audit, when you get into, sorry about that. When you get into audit proper, you're going to see things like overall materiality, performance materiality, and tribal materiality. So overall materiality is like, okay, generally these are 5%. Most audit firms stick with 5% materiality. Okay, 5%. There's a formula actually for calculating the materiality. We'll look more into that when we're talking about that standard proper, right? So, but then just so know that coming, I jumped something. Sorry about that. Okay, materiality, materiality. Okay, yes. So ISA 320 provide guidance on how to set up your benchmark. That there's a way different audit firm does theirs. Different audit firm have their own different ways of setting their materiality benchmark, but that materiality benchmark has to be set. So ISA 320 also indicated that the auditor has to be alert for management bias. It's still part of your professional skepticism. It's part of your professional skepticism, right? So we're looking at ISA 450. Okay, so ISA 450, we'll look at that um, as we proceed. So this is under ISA 450 that we have things like performance, materiality, um, how to revise materiality, and also documentation for all these thresholds. So let's look at ISA 402. That is the audit consideration relating to an entity using service organization. Now, when we're talking about service organization, we're talking about outsourced outsourcing agencies, right? Or outsourcing firms. For example, some companies could be outsourcing their HR function. So if they are outsourcing any function at all, this particular standard becomes imperative for you to consider in your audit. ISA 402, and it also provides is recognizing the fact that there's an increased use of service organization that is outsourcing agency. That's because a lot of companies just want to focus on their core business operations and just leave the other ones for an outsourcing company to do, because they believe that they are professional enough to provide that service at a fee. Provide that service as a fee, right? And some of the requirements for that ISA 402 include specifying matters to be included in the auditor's understanding of how the entity uses the services of a service organization. So as an auditor, you have to understand the nature of that outsourcing relationship. For some companies, they outsource some parts of their HR function, not all the parts of their HR function. So it gives you an idea of how you are going to go about your auditing. What are you going to check from the end of the outsourcing agency, and what are you going to check from the client end, right? So it also includes that where the auditor has also concluded that the controller, the service organization operates effectively. So as part of the consideration in this ISA 402 is that you have to be convinced, or you have to be convinced that the controls at the outsourcing agents or the outsourcing firm is actually solid enough, right? For example, so a firm tells you that they are outsourcing their function to one outsourcing their HR function to one individual, and the professional qualification the individual does not have. I mean, how can you now make a decision based on that the result of that outsourced function? That becomes a problem. So it also talks about the types of reports that you can get from an outsourcing agent. So yes, we also talk about the controls, how to test the controls of those service organizations. We go deeper into that as time goes on. It also talks about the procedures that you should perform. You should perform as well to gather audit evidence from that particular service organization. So now we're looking at ISA 450. ISA 450. Now remember, under the ISA 320, which is the materiality, there was a connection between that and this ISA 450, right? Because there's a relationship between materiality, and also this misstatement being identified in the financial statement. Now remember, in our that the financial statement is not materially one, two, misstated, right? Materiality is covered in ISA 320, misstatement is covered in ISA 450. Both of them actually go together because that is what we are expressing an opinion on. Items that the financial statements are not materially misstated. So you have to consider materiality when we're talking about misstatement, right? Let's move on. There are a number of requirements which includes accumulating all identifying misstatements other than those that are clearly trivial. Like I said, there is the overall materiality, there's the performance materiality, and there's also the trivial materiality. We'll look more into that when we're talking about ISA 320, but like as a summary, the trivial materiality covers items that you can overlook. For example, you're auditing MTN, for instance, and you are finding 100,000 naira misstatements. I mean, 100,000 misstatements to a company that their turnover is in billions. I don't know what the actual turnover is, but I think it's in billions. So their turnover is in billions. It's clearly immaterial. It is very, very clearly immaterial. In fact, it's not even up to the trivial materiality stage. So it's not even meeting any of the materiality. It's not meeting any type of materiality level, in fact. So these are things you have to consider. And then also this ISA 450 provides guidance on you evaluating the effect of uncorrected misstatements, reassessing materiality. So there are some mistakes that you could find in the financial statement, and if they are not material, if they're not even up to the trivial materiality, you just let them go, right? Because when you consider the adjustment, and like this money is never material, you are correcting. You want to correct a 20,000 misstatement out of a from a company whose materiality is in billions. I mean, it's really not material. So what's the point? What would be the implication of you making that correction? Clearly immaterial. So it also provides guidance as to determining whether uncorrected misstatements are material, considering their nature as well as their size. So when we're talking about materiality and misstatements, you have to consider not just the size, that's the amount. You have to consider also the nature. For example, in MTN, like I said, when we're talking about 100,000 naira misstatement, that is in amount. But if the nature of the misstatement is such that is so embedded in the system that there's a likelihood that if it is not stopped, if that system is not rechecked and stopped, it could lead to billions and billions of misstatements in the future. That has to be pointed out. It now becomes materiality by nature. It becomes materiality, it now becomes material by nature, not necessarily in size, but in nature, because we have evaluated and seen that if the system goes unchecked, there's a likelihood that it could be used for fraud. There's a likelihood that it could lead to much more um, material misstatement in the future if it's not nipped in the bud. So this has to be considered. It also provides guidance on documenting the amount which is below material misstatement. I talked about that, which you consider to be trivial. It also talk about documenting misstatement that you have to accumulate during the audit to know whether they are corrected or not. It also considers documenting the auditor's conclusion as to whether uncorrected misstatements are material. Like you said, before you can even say you want to correct something, you have to consider the materiality. If it has no material value, materiality in terms of size and in value, then I mean there's no point of breaking a sweat because of that. Okay, then talk about external confirmation. So you see a lot of this under evidence, right? Type of evidence that you can get. Now remember, okay, before I go there, well, let me not go there yet. Okay, so we're looking at ISA 505 external confirmation. So this involves provide more detailed requirements about maintaining control over confirmation requests. Now, in audit, there's something called confirmation. Now, confirmation is you reaching out to a third party to confirm either a balance or to confirm an information that the client provides to you. For example, part of the audit requirement is to ask your client and get representation that there is no pending legal issue. Now, when there's a pending legal issue, now looking at contingent liability, pending legal issue, that there's likelihood that they are going to they are going to lose some money that will materially affect the company and all. So if they say that there's no pending legal issue, you still have to send you still have to circularize, that's the word. You have to circularize an external third party, that is the legal advisor or the solicitor for that particular client, for them to confirm that there is really there's really no legal issue. This is also done for bank balances. This is also done for um, debtor balances. This is also done for trade payable balances, right? For you to get external confirmation, and in all these, external confirmation is more relevant than an internal internal representations or what management tells you. I mean, if the management is providing, for example, in their bank statement, their balance is like 1 million, but then in the and not bank statement, like if the client provide a ledger to you and the closing balance of that bank ledger is showing 1 million, but when you secularize and their bankers to get confirmation, you are seeing 12 million, you will it is expected that we believe that the bank is more independent than even the individual. We can trust the bank because we know that the bank is highly regulated, right? We can trust what the bank gives to us compared to what the client gives to us, because they can give us any information depending on their own financial objectives. So ISA 505 also provide detailed requirement about obtaining further evidence to resolve doubt over the reliability of responses, right? So how do you evaluate uh, what the management is telling you? If you have so much doubt that, man, I think this guy is lying, I think his accountant is lying. Let me confirm the balance. That, for example, in their books, they show that somebody's owing them 5 million, and you have seen so much discrepancies. You can decide to secularize that particular client that is showing that the balance is showing 5 million. You just ask the client, although everything is written, so you have to you secularize the client for them to provide info about the amount that your own client is showing them, is showing in the books, and then you do your own checking. So if it doesn't align, then you know that there's a problem and you have to perform additional audit procedures. It also provides requirements about conditions that must be present if negative confirmations are to be. So there are different types of confirmations, right? There's the open-ended, there's the closed-ended, there's the negative. We'll look more into that when we're going deep into the standard. That's the ISA 505. So ISA 540 is about auditing accounting estimates, including fair value accounting estimate and related disclosures. So ISA is about auditing accounting estimate. And you know what accounting estimates are? Accounting estimates are areas that the management's judgments are involved in. For example, depreciation. Depreciation is an accounting estimate, right? When a management tells you that our depreciation policy is that our vehicles will be depreciated at 50%, because that's just our own accounting policy, is just an estimate. The accounting rate is just an estimate because there is no standard rate for a car or for a van or for whatever. But then an auditor has to ensure that those accounting estimates reasonable, right? So I say for 540 um adds more rigor to the auditing of accounting estimate, especially with the view of considering the potential for management to be biased and decide to do some creative accounting, basically cooking the books of accounts, because the area of estimate is a very significant or a risk area, because I mean, if a management tell you that this is based on my judgment, there's no standard, there's a risk there, because does your judgment make sense in line with the standard, in line with conceptual framework, in line with what the auditor or with the auditor's judgment, does it make sense? So this ISA 540 provides more guidance about the rigor with which accounting estimates should actually be audited. So it introduces requirements for greater rigor and skepticism when it comes to accounting estimates. It also provides guidance on what constitutes a misstatement, and also indicators of what a management bias could look like. It also focuses on areas of estimation, uncertainty, and risk. We'll look more into this one as we go. And when we're auditing accounting estimate, this is one of the reasons why, like I said, the auditing is changing, right? And part of the skills that you need as an auditor is with data analysis. Data analysis will help with is a necessary skill to actually help with this estimate, to check if they are reasonable. Because the management cannot just wake up and say, I'm making my decision based on this. There has to be calculations, there has to be basis, there has to be a basis of that particular decision, and it's your responsibility as an auditor to evaluate whether those bases are reasonable or not. And so the skills of data analysis actually comes and in evaluation of trend, trend analysis, ratio analysis, and all those things like that comes handy when we're talking about the audit of accounting estimates, right? Now, so the standard also provides the requirement as to how as to obtaining understanding as to how management identify the need for accounting estimates and how they make those estimates. So basically, it provides requirements for you to have an understanding of the basis. There has to be a basis for anything any management wants to take. There has to be a basis. If there's no standard for it, there has to be a basis, and the auditor has to check to ensure that the bases are actually reasonable, right? Now, it also includes reviewing the outcome of accounting estimates made in prior period. So, if, for example, if they made an estimate that their sale is going to increase by 50% last year, and then in this year, I mean last year, they made an estimate about the next year and said that, okay, um, our our revenue increased by 50% and it increased by only 2%. That might be a potential problem to say, okay, these guys are over. There's a likelihood that they are overshooting a lot of things, because the estimate they didn't even achieve, or they didn't even achieve close to what they estimated. So that now becomes a problem, now becomes an audit issue if it's very material. So it also includes reviewing, okay, I said reviewing the outcome of accounting estimate made in prior period. It also includes evaluating estimation uncertainty and whether high estimation or certainty leads to significant risk. We'll look more about that as we progress, right? And the deeper you are in audit, the easier it is for you to understand this thing in practice. And also, the stronger you are in SFM, strategic financial management, also helps with um, with all of this, with these models, with this analysis. You know, it helps you. It's a necessary skill. So that's why you can't you can't say you want to prefer one course over another course. Every single accounting course, every single ICAN course is necessary for equipping you to be a better professional accountant. So you need to factor that in your preparation, have that mindset to get everything, understand all the concepts as much as possible, because they are going to come handy, if not immediately, sometime in your career. Okay, so and it also provides guidance for identifying significant risk, um, which includes evaluating how management has considered alternative assumptions or outcome, obtaining sufficient appropriate evidence about whether management decisions are in accordance with the IFRS framework, conceptual framework standards. There has to be a basis, as I said. It also involves evaluating the adequacy of disclosures of the estimation uncertainty? Are they disclosing that this is an estimate and it is based on blah blah blah? There has to be proper disclosure. It also talks about the reviewing management judgment and decision in order to identify possible management bias. So in all of these things, you have to be as skeptical as possible. Are we together? If you are with me, just say something. If we are together, say something.
I'm with you. I'm with you.
Okay.
We are together.
Okay, fantastic. Thank you for your response. Okay, so now looking at ISA 550 related parties. Now under your ICAN, I say ICAN, in your corporate reporting, you see this is I think it's part of the standard for related parties, right? And the whole definition is also included inside that. So you may have to go into your study, but like I said, every single course in this ICAN is very, very important. They all go hand in hand or hand in glove. Yeah. So they all go hand in hand. So related party ISA 550 was revised in response to a major scandal, Aaron and WorldCom 2002, which involved related parties. So there's also the need for more risk-based approach. We look at that when we're talking about audit approach, as we dig more into into audit, because there are different type of approaches. How you are going to approach client A might be different from your approach for client B. For example, that client that you hypothetically talked about, whose records are not in place, the approach that I will use to audit that client will be different from the approach I'll use to audit like a MTN, because in a company like MTN, the systems are already in place. So I can decide to place some reliance on their internal control and not do too much testing. Not like too much testing. There will be testing, but then I may just do more of more sampling, because I believe that in their system, the possibility of risk is lower, and I could place some reliance on their system. But in the case of that type of hypothetical client that you talked about, I have to do more substantive testing. We'll look at the definition of some of all these things as we go into the audit, right? So that has to be considered. I say 550 now puts more attention to a risk-based approach. Look at that in line with other ISAs, and also it seeks to assist auditors to identify related parties and also undisclosed related party transactions. This related party is a high-risk area in a lot of clients, because like related party, for example, okay, let's talk about the definition of related party. So related parties are basically it could be an individual, it could be an institution, it could be an organization that has significant influence on what happens in a client. For example, I have a client, let's say I have a client like MTN, and MTN has a sister company, not a subsidiary now, but saying has a sister company, maybe let's say MTN is related to one other company in Nigeria, right? Let's say the company produces what could I say? The company produces hardware, for instance. So let's say MTN sister company is Huawei now, for instance. Huawei that is involved in hardware, all this IT hardware. Now, MTN can decide like when they are transacting together, they can decide to overstate or understate the value of the transaction that they have with their sister company, depending on their objective. If they want to show more profit, they can decide to understate the amount, the value of whatever transaction that they have with their sister company. So depending on that, so the related party has to be properly disclosed. An auditor has to ensure and check that all the related party disclosed in the financial statement are really all there is, and be skeptical that there's a possibility for more. As you're checking most of the transaction in the ledger, you're checking where money is going to, money is coming from, you will be able to, as an auditor, identify based on your judgment that there's the likelihood that or they're hiding something in this account, that there's a sister company, and then you start to ask questions. All of that linked to professional skepticism, right? So the new requirements include considering the susceptibility, that's how vulnerable the financial statement is to material misstatement due to fraud or error arising from the entity related party relationship and transaction, like I said. So they can decide to overstate and understate, and because in this case they have a relationship, so they are going to communicate how they are going to overstate or understate. Unlike a third party, it's going to be very, very difficult for you. For example, I want to buy phone from Samsung. Will I tell Samsung that, Samsung, please sell this thing to me as a low, at a cheaper price? The way they will chase me out, I won't even believe it, because those are third party. But if it's a related party now, let's say it's my husband now that is selling the phone, and like, guy, sell this thing. I know you sell it 60,000 people outside, sell it to me for 40, and because he is considering, oh, we have a relationship and he wants to sleep well in the night, he might decide to now go below the arm's length transaction. You see more of that in your corporate reporting when you're looking at related parties. So IFRS and IAS, like I said again, this is another thing bringing it out. It shows the relationship, like what we're explaining here now shows the relationship between IFRS and your IAS. You can't be a good auditor if you don't have a good understanding of the international financial reporting standard, because as we said, that is your suitable criteria. Now, obtaining an understanding, okay, new requirement also involves obtaining an understanding of the controls that are put in place to identify, account for, and disclose related party relationships and transactions to approve significant. So basically, the auditor has to be aware of, they has to be informed, they has to be convinced that there's enough control to ensure that there's no related party transaction or relationship hiding somewhere, right? And also the requirements also include treating significant related party transactions as giving rise to significant risk. So it also specifies the procedures to be conducted if the auditor identifies related party transaction that was not disclosed that was not disclosed to the auditor. So of course that raises a red flag. Why was it not disclosed? What are they trying to achieve? So there might be more audit procedures in that case. So ISA this ISA 550 specifies what an auditor should do in that particular instance. And also it also provides guidance for significant transactions outside the normal course of business. If you go through your related party transaction in IFRS, you have a good understanding on why all these are specified by this related party um, auditing standard, right? And also includes guidance on obtaining sufficient appropriate evidence about a management assertion. We'll look at assertion as we go forward in the future, that a related party transaction was conducted on a normal commercial terms. So basically, they provide guidance on how the auditor would test or perform procedures on management assumptions about related party transactions that they want us to believe. That's what assertions are. If management is asserting something, they are saying that this is what they believe, and what they want you to believe. Those are the assertions. So basically, this standard provides a guide on that, testing those assertions. So let me see how much we have. Okay, I think this is the end. Okay, so um okay, so written representations, ISA 580. So ISA 580 was revised to respond to certain concerns that the auditor may have over written representation. Like you said, most of the communication between an auditor and the client has to be documented, especially in material aspects about material issues that were raised, material matters that were raised in the audit. It has to be properly documented. So written representation is so this standard now provides further guidance on how to relate with written representation. So this makes it clear that written representation does not provide a sufficient appropriate evidence. When we are doing ISA 500, you see that's audit evidence. You see some of the reasons why we cannot totally rely on written representation from management, right? Because it is internal. Something that is internal, external has more relevance than even what is internal, because there's a likelihood that the management might be biased in the information that they are giving to you, or biased in the representations that they are giving to you, right? So this standard provides a lot of guidance into that. It also ensures that this standard also ensures that the management provides written representation about their own responsibilities. I think we talked about this in we were discussing audit, agreeing audit engagement, agreeing in terms of audit engagement, where we said that the management has to provide a representation that they understand fully well their roles and responsibilities, and they understand and accept their responsibility for the financial statement, right? Ensuring that showing written representation that they are responsible for preparing the financial statement, they are responsible for giving the auditors access to the information that they need. They are also responsible for recording all transactions and reflecting them in the financial statement. That they are also that if they do not provide the above, disclaiming an opinion on the financial statement should be the option. So they have to also state that if they are not true to this their responsibility, the management can decide what the auditor can decide the kind of opinion that they want to provide in that particular instance, right? So I say 600 is about special consideration, the audit of group financial statements. So for you to better understand what happens here, you have to know your IFRS 10. You have to know your business combination. I think that is IFRS, is it 3 for business combination. You have to know your group accounts very well, because the more knowledge you have about it, the easier and the better it is for you to know why some of all these procedures are actually important and are specified by the standard. Okay, a quick tip that I would like to give to you. I've always been referring to the IFRS, right? So if you want to really succeed in audit, you have to be able to connect. You have to be able to make connections, not only in audit, even in case study, in any exam. You have to be able to make connection. You cannot cram audit. That one is that one is sure. You cannot cram audit. And it's your understanding that will help you in passing the audits. How much understanding do you have? Like some of all these procedures, if you understand their implications under the IFRS and under your corporate reporting, it's going to be easier for you to know the test, even without cramming the test. You will just read through the test, you will understand the test, and then you will know what you are going to do in that particular instance, right? So the ISA 600 special consideration, that's for those that are into group accounting, and it also includes the work of component auditors. So component auditors are those are used in the case of a group. For example, there's a parent company and there's a subsidiary company. For the subsidiary company, they can appoint their own auditor. They can appoint their own auditor, because in as much as they are in a group, they are still a single entity. I don't even understand that. They are still a single entity. We still see them under the business entity concept. We see the entity as a single entity. So they will also present their own financial statement, and then the parent company prepares the consolidated financial statement. So this provides guidance on the work of component auditors. That's the work of those who will be working on either the parent company or auditing any of the components in that particular group. So it provides new requirements about deciding whether to accept or continue an appointment as the group auditor. So the group auditor is the one in the parent company, actually. So it provides requirements as to whether or not you should continue the appointment as an auditor, considering whether the group team will be able to be involved in the work of component auditor. So these are the considerations. So will you, as a group auditor, Will you be able to evaluate the work that the component auditors are doing? Can you trust the work that the component auditors are doing? Is there enough quality in the work that the component auditors are doing? So this standard provides a lot of guidance into that. It also includes obtaining an understanding of the group. We need to know who is the subsidiary, which one is the ordinary investment, which one is the associate. You have to be involved about this one. Is it the D-shaped kind of group? Is it the parent, grandparents? All of these things, you find them in group accounting. The more solid, as I said, the more solid understanding you have about group accounting, the easier some of all these procedures and even understanding what I'll be explaining when we get into this um, is going to be, right? It's going to be. So it also involves obtaining an understanding of component auditors. You can't just be auditing and you can't rely on a component auditor if you are not involved in what's happening, if you don't trust them, as we said. So you have to be sure of their professional competence. You have to be sure that they are aligning with ethical requirements, right? You also have to consider the maturity level for the group. It's the group auditor that will do that. The maturity level for the group as a whole, and what should be the maturity level for the component. And you can't do that if you don't have an understanding of the structure. You don't have an understanding of how the group actually works. It also involves responding to assessed risk, including requiring an audit of the financial information. So this is basically about what you as a group auditor, that if you accept an engagement as a group auditor, supposed to consider when you're assessing the risk of that particular group, right? Including requiring an audit of the financial information of any component which is of individual financial significance, right? So you can decide and say, okay, this component is the transaction happening in this component is material. Let's say the group company is generating maybe like 1 billion, and then one component is generating like 600 million. Of course there has to be a proper audit of that particular component as opposed to the one that is maybe providing only 1 million, 1 million or 2 million, or even 10 million compared to 1 billion. I mean, it's not material. So you have to consider the risk of auditing, requiring an audit of each of these components. You also have to consider responding to the risk, including audit of financial information about specific areas in the component. Also, analytical procedures is also key at the group level for non-significant components. It also involves determining the level of involvement of the group engagement team in the work done by the component auditor. So a lot of all these considerations are put in place when a group account is being done. What is the extent of involvement that the group auditor is going to have in the components, in the audit of the component part, right? Then we also have ISA 620, which is using the work of an auditor's expert. So there are some areas where an auditor may not be an expert in. For example, areas like valuation, areas like actuarial valuation as well, actuarial valuation, areas like fair value measurement. You might need an expert to do that, or determining the fair value of a land. You need a surveyor who that does his own job to provide you with information about that. So this ISA 620 um, was revised in response to concern that experts should be used not only in relation to accounting balances, but for purposes such as risk assessment. For example, if you want to assess the risk of retirement benefits, you might have to involve um, you might have to involve an expert, right? Also, it was revised because there's now increasing use of fair value accounting, right? And then also a skilled individual, um 1 minute please. A skilled oh, sorry. Okay, so a skilled individual might be a skilled individual would be needed for that particular function. Where am I? Okay, yeah. So now this standard also restricted the use of an expert engaged or employed by the auditor. So this is talking about management experts, right? This is talking about management expert. 1 minute. Okay, let's keep it like this. Okay. Sorry, 1 minute. Um, mm, mm, I think this is even better. Okay, so so this ISA 620 is about using the work of an auditor's expert, not about management expert. So ISA 620 was revised in response to the fact that there's a lot more fair value accounting being done, and also for risk assessment purposes, right? So it's restricted to the use of an expert engaged or employed by the auditor. So this is ISA 620 is about the expert that an auditor employs. An auditor calls for, rather, not the one that the management employs, the one that the auditor actually employs, right? So let's say you are auditing a client and then you realize that there's a whole lot of evaluation going on, and you as an auditor now contract, an expert to do some valuation, right? It also includes specific audit procedures in respect to agreeing the work to be performed, and also evaluating the reasonableness of expert findings. So as an auditor that is contracting an expert, you have to be clear with the expert on the areas that the expert is supposed to cover, and also how you are going to evaluate whether what the expert is doing, the evaluation that the expert is doing, is reasonable. So that brings me to to point out that the fact that you're employing an expert doesn't mean that you should be a novice in that particular area. It doesn't mean that the auditor will not have a knowledge. The auditor would need to have a basic knowledge about that particular expert work, so you will be able to evaluate whether the results or the report of that particular expert is actually reasonable or not. So ISA 200, we're back to ISA 200, overall objective of the independent auditor and the conduct of an audit in accordance with international standards on auditing. Now, the objective of an auditor as per ISA 200 is to obtain a reasonable assurance. Sorry, to get this off. Okay. Is to obtain a reasonable assurance about whether the financial statement, we have discussed extensively about what reasonable assurance is as opposed to an absolute assurance, right? So obtain reasonable assurance about whether the financial statement as a whole are free from material misstatement. We have discussed about materiality and about misstatement, right, due to fraud or error. So fraud and error has its own ISA, has its own standard that has to be considered. So this allows the auditor to give an opinion on whether or not the financial statement have been prepared in accordance with the applicable financial reporting framework. So that's the on auditing 200. So the ISA 200 also stated that the objective of the auditor is to report on the financial statement. Keyword: report on the financial statement. The scope is financial statement, and communicate as required by the ISA. So we talked about the ISA in charge of communication, which was what ISA 260 and ISA 265. So you have to know all of these things. The more you understand them, the easier it is for you to know where all of the elements in this financial statement fit in, right, in accordance with the auditor's findings. So where the auditor is unable to obtain reasonable assurance and a qualified opinion is insufficient. Now we'll look at that under reporting. I think ISA 700 or 705. is insufficient, an auditor must disclaim an opinion and resign. There are different situations that might lead to this, where the auditor may have to qualify the financial statement, that's give a qualified opinion, or even have to give a disclaimer, or even have to resign. We'll look more into that as we dig into the audit. So there are different types of opinions as covered in a later chapter, as I said. So in line with the audit, in line with what you should remember in your previous study, so ISA requires, these are the key requirements. The first one we talked about was the objective, right? So next we have to consider the key requirements of ISA 200. So the ISA 200 requires that as an auditor you have to comply with all the ISAs that are relevant to the audit. Keyword: relevant to the audit. All the ISAs are relevant to the audit. Like I said, under the ISA 402, where we're talking about this special service organization, right? There are some companies that you may not need to consider that particular standard for, because they don't have any outsourced services. Everything is done by them. So you just have to comply with every ISA that are relevant. Relevant is the keyword, that are relevant to the audit, right? So if the client that you're conducting an audit for is not a group account, you don't have any business with ISA 600, which is about specific consideration for the audit of group accounts, right? So that's one of the requirements. Another requirement that the auditor has to comply with relevant ethical requirements. So we'll look at ethics as we progress in the future. Ethics like integrity, confidentiality, professional competence and due care, technical standards, all those has to be complied with. You have to be full of integrity. You have to be objective when you are giving your opinion. Even when you're conducting a test, even when you're asking management questions, you have to be objective as much as possible. You have to keep the client information confidential, because they don't get to show everybody. It's their personal and private information. It has to be confidential. So you have to, as an auditor, you're required to comply with all, in fact, because all the ethical requirements are relevant. You have to comply with all the ethical requirements, right? You also have to plan and perform an audit with professional skepticism, with an inquisitive mind, with a questioning mind, that there's a likelihood that this place is going to be a risk area, considering the meeting we had to them, considering COVID, for example, considering COVID. Okay, we have to spend more time on evaluating their going concern. We have to do more confirmation. You have to plan and perform the audit with professional skepticism, because you don't have that luxury of doing an absolute audit. So you don't have the time, neither do you even have neither can you even give an absolute assurance, because audit is subjective, right? So you have to, in your planning stage, you start from the planning stage. You have to plan and perform an audit with professional skepticism. The auditor also have to exercise professional judgment in planning and performing an audit. Like you said, you don't have all the time in this world. So it involves a lot of judgment. Hey, this is a high risk area. Hey, this area, this is the materiality level. This is what we're working with. This is the audit procedure that is necessary, considering the circumstance of the client, considering the item or the element that we are auditing. All this has to be factored in beginning from the planning stage, before you even get to the performing of the audit. Also, the auditor is required to obtain sufficient and appropriate audit evidence to allow him obtain reasonable assurance. That is a key, also a key requirement. All of them are the key requirements. Comply with all the ISAs that are relevant to the audit, comply with relevant ethical requirements, plan and perform your audit with professional skepticism, also plan and perform with professional judgment, and also obtain sufficient in terms of numbers, and also appropriate in terms of relevance audit evidence, to allow you as an auditor obtain reasonable assurance. So we bring the class to a close. We continue this in our next class. So thank you very much. I'm taking questions now. Taking questions.
Oh, thank you very much for the class. It's detailed and really I don't have questions for now. What I think is that we'll have to go through the material again because where
Yes,
I'm
please
present,
do.
I'm at work and a lot of distractions. So I'll go through it again, and if I have any questions, I can drop on the forum or whatever channel I'll be looking. But so far, I
Okay,
think I really gained and I got to value for on this class.
thank you. That's really good to hear. Odedele Sheung, you just joined us, I think, during close to the end of the class. Did you get anything of value? You can unmute, so let me unmute. Odedele Sheung, are you here? Okay, so in the absence of any question, and I think Sheung is not online at this particular moment.
Hello?
Okay. Yeah.
Yeah.
Hi, Sheung.
I'm fine. I'm sorry I came late
Good
for the class
afternoon.
today.
It's
I
fine. You can always
was
listen to.
I was a bit busy. That was why.
Okay. But did you get one or two things when you joined? I saw when you joined in.
Yes. I should be able to grab some things.
Okay, Sharon, you
Okay.
can rewatch the class later.
Oh, please, I would love to know how to rewatch the class
Yeah,
later.
it's going to be available on
We'll
our
send you the
YouTube
link.
channel. So kindly go to our YouTube channel. Just go to YouTube and type ICAN Online Tutors in the search bar. Then make sure you subscribe. So we
Okay.
are going to post it there. So you have a chance to rewatch it.
All right. Thank you, sir.
You're welcome.
Okay. So thank you very much for this class. See you in the next class.
Okay.
Next
Bye.
class. All
Okay.
right.
Take care,
Bye-bye.
everybody. Bye.
Take
Yeah,
care,
bye.
sir.